price pressures ease, the manufacturing purchasing managers index rose to a level that signals an expansion in production. That is the first time that has happened in 3 months. In the US Senate, a must-pass defense spending bill is on shaky ground. A vote to cut off debate failed after Republican senators demanded consideration of more amendments. That risks derailing the traditional bipartisan legislation. Among other things, Republicans want an amendment that will impose more sanctions on Russia's Nord Stream 2 gas pipeline. A U.S. Labour official has ordered a new union election at an Amazon warehouse in Alabama. The union had accused the company of intimidation. Amazon denied it. The regional director for the National Labour Relations Board said that Amazon hijacked the process and made a free and fair election impossible. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
So by August 18th, we were back in record high territory, which was the third.
Hey guys, you can see position closed on this bound. All 3 positions are closed. I will show you how much profit and loss we gain from trading British pound. At the end of the day, we received already confirmation from our broker.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Leni Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Where's the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I definitely think that this threat is something that we have not seen before. The number of variations, mutations on this virus are surprising. They're not theoretically impossible, but extremely rare. And so we have to take it for the serious threat that it poses.
Nubar Afian there, the Moderna co-founder, speaking to Bloomberg recently from New York City this morning. Good morning. Tom Keene, Jonathan Ferro, together with Katie Lyons. Lisa back with us tomorrow. Your equity market down 44, let's call it 45. We're negative about 1% on the S&P 500. Some risk aversion out there again. Yields in on 10s by 6 basis points to 143.92. A reason or an excuse for a sell-off? Did you see anything new in the Moderna CEO comments to the FT? Knows the answer for many people, Tom. And here are the comments for other people to make that decision for themselves. There is no world, I think, where the effectiveness is the same level. I think it's going to be a material drop. I just don't know how much, because we need to wait for the data. But all scientists I've talked to are like, this is not going to be good. That's the comment from the Moderna CEO to the FT. And Tom, I don't think that moves things along much at all, considering what we already knew 24 hours ago.
Yeah, I mean, that's where we are, where we're staggering from news item to news item. And, John, there is a frenzy out there. The president addressed that yesterday. I take real issue with some of the media hype of high alert and the rest of it. We're down, we're down 2%. And, John, that's where we are. Let's bring in an expert. I'm not the expert. Neither is Kaylee Lyons or Jonathan Farrell. Amish Adalja he's not only senior scholar at Johns Hopkins Center for Health Security and practicing medicine, but very importantly has a financial background out of Carnegie Mellon. And we do the Pittsburgh Carnegie Mellon math with Dr. Adalja this morning. Can you calculate the certainty or uncertainty of this new variant, or is you as blind, Dr. Adalja, as everybody else seems to be?
I don't think I'm blind, but there still are a lot more questions than there are answers, and it's just going to take a little bit more time to get certainty. But I think that we are really rapidly trying to perform the scientific experiments to understand the epidemiology of this variant, to be able to adequately risk stratify it and know where it fits in the world of Delta and Alpha and Gamma.
Let's go Tepper, Dr. Adalja. Is it a bell curve? Is it a normal probability distribution of risk? Or are there skews or cross moments to it that we should be fearful of?
I think it's not necessarily a normal curve. I think that there are going to be heightened risk in certain areas. So, for example, it's not surprising that this variant was first discovered in South Africa, where only 25% of the population is fully vaccinated. And there's also a risk in terms of how you're thinking about what you want the vaccines to do. I think it's likely that breakthrough infections are probably going to be more common with the Omicron variant, but they may be not severe in a fully vaccinated person, meaning that the vaccine still protects you against hospitalization and death, which is what they want us to do, what we want them to do. So we may need to adjust the vaccine, but I think it's important to remember that what we're trying to do is keep people out of the hospital, and it's very hard for any variant to erase everything a vaccine does for you.
Doctor, you're picking up on the really important points, as you always do. There's transmissibility, there's vaccine efficacy, and then there's disease severity. On the latter point, how long do you need to get a fuller picture of that? What we've learned so far, and very, very early days, sir, so far we've heard about mild cases. How much longer do you need, sir, to get a fuller picture of that?
Probably a couple more days. I want to just look at the epidemiology and the clinical features of the people who are getting infected. What we're hearing from South Africa is that these tend to be mild illnesses, but they're occurring in younger people who tend to have mild illnesses to begin with, so you can't really take that at face value. We're also hearing that the hospitalized individuals tend to not be vaccinated, which makes sense. I just need to get a little bit more of a denominator there to see exactly how common that is, but I don't suspect this is more virulent, and I suspect that the vaccine does what it's supposed to do when it comes to severe disease, just like it did with the Beta and Gamma variant, which were able to get around the vaccine and cause mild infections in fully vaccinated individuals, but not able to cause severe disease, and I think that's the goal.
Yeah, Dr. Adalja, just to clarify, we aren't talking about a vaccine outcome being binary. It either works or it doesn't work. We're talking about degrees of efficacy, correct?
Right, it's a continuum. It's protection against any infection, protection against mild disease, protection against moderate disease, protection against serious disease, protection against hospitalization, and protection against death. And where a vaccine falls on that spectrum varies. But the really important part is the tail end of that, serious disease, hospitalization, and death, because that's what flattening the curve was all about. That's what we're trying to do, is tame this virus. We're not eradicating it. We're not eliminating it. We're trying to make it something that's more manageable. So even with the Omicron variant, if vaccines hold up against serious disease, I think we're in a good position. We may need to modify them just to get better, but I think that still should give us a lot of reassurance that we're not going to see hospitals get crushed if we've got enough vaccine in people's arms.
I've got skin in the game for the next question. Many people do. We've got travel plans over the holidays, Doctor. I just wonder, can I get your thoughts on travel restrictions, this knee-jerk response over the last several days to what we've seen transpire from South Africa and beyond?
Travel restrictions are always disastrous in my mind. They enhance the disruption that the virus or the variant causes, and they really make no sense, because if this is a more transmissible or an efficiently transmitting variant, it's likely everywhere you look as soon as you start to look, because it's already left the area that it originated in. And that's been the case. We've got community transmission in Belgium, community transmission in Scotland. We have cases all over. And it's not surprising that you're finding them, because that's what this virus does. And the travel bans give people a false sense of reassurance, and they distract public health resources, and they make it worse for those countries that actually should be getting praise. So South Africa is an exemplar of what the transparency and the adeptness at sequencing that we want to encourage.
Yep.
Now there's a disincentive to do that. And now South Africa is having problems getting reagents to do those experiments that we so much want to know the results of to understand Omicron. So this is a disastrous policy. I've never been in favor of travel bans. It's something that politicians do because it makes them look like they're doing something, even if they're doing something wrong. And it's really short-ranged and unprincipled.
Doctor, always great to catch up with you, sir. And I know you've just done the overnight shift, so thank you for making some time for us. Get some rest, sir, as always. Dr. Amish Adalja there of Johns Hopkins. Tom, on the latter point on travel restrictions, we've got a country that's done the sequencing. They're providing the data. They're talking to the rest of the world, and the rest of the world starts to punish them by shutting down travel.
Well, that's what it is, and we've all lived that. John, you've particularly lived it as well. I still go back to Hurricane Katrina, which not only for American politics, but John, I would suggest for most of global politics, changed forever politicians' behavior to crisis. They're under immense pressure because of what happened to President Bush during Katrina to get out front. And as the doctor says, even if they make the wrong decision, still, they've got to get out front because of modern media and speed of news.
Sure, I have to say that the willingness to introduce restrictions is clearly there in Europe in a bigger way, Katie, than, say, here in the United States.
Well, not just when it comes to travel. We heard from President Biden yesterday saying, don't panic, and we will not go back into restrictions or lockdown mode. That is not the case in a lot of other European countries, Austria, case in point.
Need a few more days, Tom, to get the data, to get a fuller picture. Maybe not a few weeks, according to the doctor, a few more days.
Can I bring to the attention, John,
Sure.
of a 32-page PowerPoint from Christian Malik and J.P. Morgan off their London desk. We protect the copyright. We're not going to send it out. But, John, it is stunning. It's in its acuity of how Christian Malik gets to $150 Brent, not as a base case, but as a possibility.
125 maybe next year, Tom.
Looks as OPEC is shock absorber. Do they want to be now more responsible, as he claims they will be back in the driver's seat?
They're asking a question, 125 next year and maybe 150 the year after that. Crude this morning, negative 2.8%, 68 on WTI. Equity futures down 47, negative 1% on the S&P 500. From New York City, this Tuesday morning, good morning. This is Bloomberg.
there's a pretty good chance that you use products made by Meta every single day. If you've never heard of Meta, that's because it's the new name for Facebook Inc., the parent company of Facebook, Instagram, and WhatsApp.
All right, perfect.
In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What is the biggest problem the economy has right now? Is the Great Resignation and the supply chain problem.
Economic data is going to be hard to trade off at the moment.
A lot of this good news is already in price.
We have several scenarios where rates move higher, particularly if inflation turns out to be more persistent.
I think we're moving into a period like the 60s where we had higher inflation, higher growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The equity sell-off resumes from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Katie Lyons. Lisa back with us tomorrow. Your equity market down 45. On the S&P, Tom, we're down 1%.
Down 402 points. The VIX out to a 26.71. But, John, in the last hour since we've done the surveillance dance, we've seen a nice improvement. The angst of the 10-year yield from a low 1.4155 out 2 solid basis points. John, all of that because of your sterling hour.
Thank you, Tom. I appreciate that. It is not just about Omicron, is the point we've been trying to make through the last couple of days. Tom, it's about central bank policy as well. A conversation we'll have with Alberto Gallo in just a few moments' time. Can central banks around the world maintain this dovish stance if we do get some downside risk starting to build for this economy?
And what does the volatility mean for the financial system? As I mentioned an hour ago, folks, we have seen on 10-year yield, the vanilla benchmark yield, if you will, not one, not two, but 3, 4 standard deviation moves in 6 days, from +2 to -2, +2, etc. And the answer, John, is it's volatility that's really painful for people like Mr. Gallo. They have to manage that.
Katie, some real volatility in this treasury market.
Yeah, but at least on the bright side, the 60-40 has been working over the past several days. Yes, we've seen equities down hard, but you are seeing that traditional safe haven bid into treasuries. And as you've pointed out multiple times, John, and rightly so, the short end of the curve is what we also really need to pay attention to. 2-year yields coming in every single day over the last 3 days, really re-rating those Fed expectations. The market pulled those bets forward, and now they're pushing them back out.
The bid in two sticks. Your 2-year, 47 basis points. Chairman Powell, Tom, coming up a little bit later.
I think there's a little more comment. We're all Omicron. We're all Omicroned up, John. And the bottom line is you're right to peg it at the 2-year yield, which is a central banker's yield.
The curve flatter this morning. Yields lower on 10s by about 6 basis points. Let's give you a flavour of this price action this Tuesday morning. Good morning to you all. We're down 41 off session lows, negative 0.9% on the S&P. Into the bond market, yields are lower by 5 basis points on 10s to 144.43. And in foreign exchange, in Euroland for the Eurozone, inflation coming in hot, Katie. Euro dollar 113.48. That currency pair positive 0.5%.
Yeah, 4.9% on Eurozone inflation, topping all estimates, just underscores the challenge central banks are dealing with as you have these inflationary pressures on the one hand and a lot of questions around growth on the other hand. And those are questions that Fed Chairman Jerome Powell is probably going to have to answer in the Senate today. He and Treasury Secretary Janet Yellen will be testifying in front of the Senate Banking Committee. We already know what they're going to say, at least in their opening statements. The chairman will talk about the dual mandate and how the Omicron variant affects it, uncertainty around the inflation outlook. What does that mean? I'm sure lawmakers will press him on it. He also talks about the downside risk to the employment picture. So that will be important to hear his language, especially ahead of the jobs report on Friday. Also coming up in terms of economic data at 10 a.m. Eastern time is Conference Board consumer confidence. Of course, we did see it coming down in July, August, September. We saw a slight uptick in October, but we're expected to see it come down again in November. Inflation risk, virus concerns, how much are they weighing on consumer confidence? Of course, this gauge has held up better than UMich in recent months. We'll see if that trend holds. And finally, at 1 p.m. Eastern time, more central banks speak. Richard Clarida, the vice chairman of the Federal Reserve, as well as Cleveland Fed President Loretta Mester will be speaking. Does Clarida echo what he said just days ago about an accelerated pace of tapering, or has that thesis changed with just about 2 weeks to go until that Fed meeting, John?
The vice chairman unleashed, Kayleigh. Unleashed in his final months of his term. Let's see what he's got to say again. Do you like that, Tom? Unleashed. Vice Chair Clarida, unleashed. A little bit later on. Tom, we start this morning for our audience on radio, perhaps just tuning in. Everyone's talking about this interview in the FT with the Moderna CEO. I'm going to bring you the quote so you can all make your mind up. There is no world, I think, where the effectiveness is the same level. He's talking about vaccine efficacy against the Omicron variant. I think it's going to be a material drop. I just don't know how much because we need to wait for the data. But all scientists I've spoken to are like, this is not going to be good. That's the Moderna CEO. And Tom, I woke up this morning, read the same interview you read, looked at the price action, went back to the interview and just said, what's new?
It's like when NIH used double adverbs yesterday in
probably
science. John,
highly probably.
John, these
highly
are
probably.
the material drop is science talk, and it's a little bit inflammatory. I am critical of somebody with skin in the game saying material drop when there's no science evidence.
Let's wait for the data. And according to Dr. Adalji, you need to wait at least a few more days. A lot of other people saying, Tom, it could be weeks before we get a fuller picture.
And I think Alberto Gallo's had a material drop in his portfolio.
It's been a tough couple of days. We can talk to him right now. Alberto Gallo, portfolio manager at Algebris Investments. You don't have to go there first, Alberto. I think we start with a question I know you want to talk about. Can central banks maintain this dovish stance, given the backdrop we've got currently?
I'm going to give you a very quick answer here. You know, as a bondholder in treasuries or Eurozone government bonds, you've got two choices. You can either lose money slowly or you can lose money quickly. Either central banks remain dovish, but you have the problem of inflation, or the yield curve reprices up. And central bankers are going to try to be as dovish as possible. But for the Fed, it's going to be a much harder gameplay next year, with unemployment probably having a 3 handle and growth picking up, not just in consumer goods and manufacturing, but also in services. Consumers are spending. They're spending in services. There's almost revenge spending. So, you know, it's going to be a very, very different game for 2022. The Fed is in a catch 2022 next year. They can't be too dovish. Inflation is going to bite. And other economies in the world are not ready for a hawkish Fed.
Alberto, you've always had a hugely holistic view. Christian Malik and J.P. Morgan are modeling out a sustained rate of $80 a barrel on oil, and they model out over 100 to 125 and even, dare I say, to 150. What does sustained higher oil do to the financial system and the fixed income market?
So we're going to have higher yields we're going to have persistent inflation. Inflation is not only about supply, it's about demand coming back. We're going to have weakness in emerging markets, which are commodity importers. Look at the Turkish lira breaking 13 against the dollar. We're going to have weakness in sectors which cannot pass prices to their clients. And so how to manage a portfolio in this environment is a lot more similar to the 60s and the 70s. We're still in the 60s. We still have strong growth and positive returns. But definitely the assets move in a different directions. You want to be long hard assets, and you don't want to have too much in paper assets.
If the Omicron variant causes central banks to move at a slower pace, let's talk about the Fed particularly here, do they risk falling far behind the curve?
I believe the Fed is already behind the curve. If you just step 2 weeks back, we are having unemployment on a very, very tight trajectory. We had initial jobless claims at the lowest in 30 years. It's very hard to justify keeping the foot on the pedal when there's only a few people that are unemployed. There are still a few millions of people that are unemployed, but the question is, does monetary policy really solve this problem versus increasing other issues like asset bubbles, money that goes into JPEGs and real estate prices going up, which in the end are not as productive as investment in companies. So, you're at a point where keeping the foot on the pedal is probably doing more distortions and more damage than good. So, we have been saying the Fed, is behind the curve, and they are going to hike. They're going to hike earlier than the market expects. Now, these expectations have faded because of Omicron, but they could come back. We still don't have results.
So, Alberto,
on how bad
forgive me for
is.
jumping in, sir. I want to understand with some real clarity what you've been doing over the last several days when you've seen this weakness, then you've had these rallies off the back of it. What have you been doing in the portfolio the last couple of days?
So, we have been defensive this year, maybe a little early, but, we've kept a good amount of liquidity in our portfolios. And in the last few days, we started to chip in. There isn't a huge opportunity, but you're starting to see some opportunity, in particular across cyclical sectors and sectors that are linked to the reopening of the economy. In other words, everything that is an airline or a cruise, has gone back to 2020 lows, almost pricing the scenario where people won't travel anymore.
So you've been buying airlines and cruise liners, Alberto, on the credit side, in Europe specifically, or is this a global story for you?
It's a global story. Obviously, you want to be in companies that have support from shareholders or from governments. And, these companies very often have, a year of liquidity or more than a year of liquidity. You want to be at the right part, in the right part of the capital structure. But there are selective opportunities in credit. You still want to play defense. And where you want to play offense is in a convertible debt, in things that are linked to hard assets, so commodities, convertible debt, and things that go up with inflation, which we think is going to be persistent.
Interesting. Always is. Alberto, great to catch up with you, buddy. It's been too long. Alberto Gallo of Algebris on this credit market. And not just where the risks are, where the opportunities are as well. Laurie Calvasino, a good friend of this program of RBC, put out a survey overnight, surveying 95 fund managers, investors, Tom, more specifically. These were the responses on how Omicron and the new variant is impacting their positioning. Here's one of the quotes. "I'm not doing anything until I get more information." That was the most popular choice of the people responding to her. 49% of the votes. Dip buyers were split between those who were buying nervously, 19%, and those who were buying confidently, 22%. So that's the split. 95 investors, Tom, but a little picture of how people are responding to some of this in the last few days.
Yeah, she called me about 8 p.m. and I said,
Did you respond
leverage.
too?
Yeah, I said triple leverage cash. I said, Laurie, come on.
Is that quote from you? "I'm not doing anything
at the margin
until I get more information."
Data dependent, Tom Keene.
Seriously, the jobs report Friday, I'm data dependent.
Are you? I think maybe it's lost some significance given what the focus is at the moment. Tom Keene, Kelly Lyons, Jonathan Ferro, Lisa back with us tomorrow. Your equity market down 39, negative 0.8%. Isn't Lisa tape dependent? Dependent on the tape? I think so, yeah. Beautiful morning in New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The top executives of Moderna say the world may need new vaccines to fight the coronavirus Omicron variant. Chairman Nufar Afian told Bloomberg TV the number of mutations on the virus are surprising. CEO Stefan Bancel told the Financial Times it may take months for drug makers to develop and deploy updated vaccines they can deliver in a large number. Meanwhile, oil is headed for its biggest monthly loss since the early days of the pandemic. Crude has slumped almost 20% in November. Investors are now seeking clues about the challenge posed by the new virus variant and how producers will respond. OPEC and its allies will decide on Thursday whether to halt a run of monthly production increases. Inflation in the euro area set a record for the era of the single currency. Consumer prices rose an annual 4.9% in November. That was higher than all 40 predictions in a Bloomberg survey of economists. European Central Bank officials have been reassuring citizens that they are facing a once-in-a-generation cost of living squeeze that just won't last. It is another blow for big tech from regulators. The UK antitrust watchdog says that Facebook parent Meta must sell off Giphy to address competition concerns. The Competition and Markets Authority says the completed takeover had already removed Giphy as a potential challenger in the display advertising market. Meta says it is considering all options, including an appeal. Global news 24 hours a day. I'm Leanne Gerrans. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
young woman that's watching this wants to be the next Diane von Furstenberg, what would you recommend?
Be as true to yourself as you possibly can. The more you could be you, the happier you will be.
We have already last Friday started the process of developing a tailor-made vaccine that not only we have very high level of confidence that we will have it ready within 100 days, but we have very high level of confidence that we can manufacture it by billions if needed.
Some of the commentary we've had from the Pfizer chairman and CEO. From New York City this morning, good morning. Tom Keene, Jonathan Ferro, together with Katie Lyons. Your equity market down 39. We improve a little bit. We're negative 0.8% on the S&P. Yields still come in by 5 or 6 basis points on 10s to 144. In the commodity market, Tom, crude down 2.62%. Crude $68.10.
I mean, Dow was down about 500 points or so, and we've come back nicely. But, John, it is not at all clear on the bounce that we've seen in the last 90 minutes.
No, clearly not, Tom, but we're still struggling with the why of it. And when I say the why of it, we've got a picture of the idea of what is going on more broadly around us right now, a new variant, concerns about central bank policy. I get that. But when so many people point towards this interview in the FT with Moderna, Tom, I just read through that interview again and again and again and just think, well, what's new? What did we learn overnight that we didn't know yesterday morning?
We're going to get more data. That's all there is to it. Also waiting in Washington is Emily Wilkins of Bloomberg Government. Emily, what is Washington waiting for? You can't tell me the politicians are all becoming epidemiologists and virologists overnight. How will they handle Omicron?
Well, for one thing, politicians are going to be taking a very close look at exactly what is needed at this point. Remember, back when COVID-19 first became a global pandemic, they passed a lot of funding saying that they wanted to give Americans assistance, make sure they were getting them through the pandemic. But then after President Biden came into office, you saw Republicans hold back and say, you know what, we think we've spent enough. We're worried about high inflation. And you've seen those worries also within the Democratic Party. And so you hear Democrats saying, you know what, this just means that we really need to pass that social welfare and tax package from President Biden. But even within the Democratic Party, you're now hearing Senator Joe Manchin say there are serious concerns about inflation and there's worried about pumping more funding into the economy. So a huge question mark, really, on whether we're going to see another one of those big spending bills targeted at Omicron.
Is the zeitgeist this morning, Emily, that simply they're going to continue with the booster program? And that we're going to nudge, and I mean nudge, the vaccination rate up in America? Is that all we've got?
I mean, at this point, what we heard from President Biden yesterday is that he doesn't want to go back to doing shutdowns and mandates. He thinks that the way forward is for vaccinations and is for booster shots. And I think part of this also depends on exactly what we continue to learn about this new variant. If it does spread quickly, if people who do have their current vaccines are not immune to it, that could really change the calculation for how the White House and Congress want to go forward with how they respond to the Omicron variant. What kind of questions do you expect Chairman Powell and Treasury Secretary Janet Yellen will get around this and around that fiscal spending you mentioned when they testify on Capitol Hill later on today? Sure. So we saw a testimony from Federal Chair Jay Powell saying that the Omicron variant, it's something to be concerned about, that it could lead to longer rising inflation, that it could lead to more unemployment, that it could prevent people from going back to the workforce. So he's really going to paint a picture that the continuation, this new variant, could really cause some issues with the markets and with the economy. At the same point, Powell said in a copy of his remarks that we received that most of the economists at the Fed do expect inflation to go down within the next year. And you're also going to hear a little bit of a positive picture from Yellen on this. She says that the U.S. recovery is still strong. In her remarks, she seems to make the bigger concern that looming debt limit that Congress needs to deal with, really putting pressure on lawmakers to address that. So let's talk about that. Are they addressing it, Emily? The clock is ticking.
At this point, we really haven't seen any momentum forward in how lawmakers plan to move. We still see Democrats saying that they want Republicans to join them on raising that debt limit, and we still hear Republicans saying, no way, that is not going to happen. So at this point, the clock is absolutely ticking. We do know that Mitch McConnell and Senator Chuck Schumer have been having discussions about the debt limit and how to potentially move forward. That might result in some sort of agreement where perhaps Democrats are the only ones to move forward, but Republicans sort of make it a little bit easier for them to actually get the job done, knock down a couple of those procedural hurdles. But at this point, we really don't know anything except that Secretary Yellen has marked December 15th as that warning date.
Emily, an unfair question. In the zeitgeist of this early week, and we get to the jobs report on Friday, is a bipartisan stridency towards China. Are they going to be able to, in effect, a strident tone to China on a bipartisan basis?
Tom, that's actually a really great question, because if you remember a number of months ago, the Senate did pass legislation to help the U.S.'s competitiveness with China. It had more than $50 billion in there for semiconductors, which is something that's badly needed right now across the U.S. And then that bill went to the House, where there were a ton of disputes and things haven't gotten done. Now, the discussions over that legislation did get a little bump the other week. You saw the Senate and the House saying they would come together with lawmakers and try and work on a comprehensive package. But at this point, it's just a matter of how much oxygen there is in the room for an initiative like this. I mean, they have to figure out how to fund the government. They have to figure out debt limit. They have to figure out what's going on with this social tax and welfare plan. And that doesn't leave a lot of time right now to focus on China and what Congress's response to China needs to be.
Emily, thank you. Emily Wilkins down in D.C. On that point, Tom, we still have American corporations absolutely petrified of saying anything even remotely derogatory about the Chinese Communist Party. And JP Morgan's Jamie Dimon was an example of that over the last couple of weeks, Tom. There's a man who leads a bank, very outspoken on a whole range of issues. If there's one person you would think that could say something and wouldn't have to apologize afterwards, a lot of people would have picked him, Tom. Well, but he was no different to what we've seen in the years before.
You know, Greg Valliere had this morning, and others as well. It's clearly, John, within the zeitgeist. And how do you respond? And what will be the response of China in terms of not only the stuff from there that comes to America, but critically how they accept our exports into China? That's not to be underestimated.
Tom, what I think is interesting is for years now, there's been this worry about upsetting the Chinese Communist Party, and then the Chinese Communist Party makes the decision for them anyway. Great example of that, listings in the United States of Chinese firms. Do you remember the conversation about tightening up restrictions, or at least getting them to play by the same rules that US firms have to play by when they list in America? And all of a sudden, what have we seen in the last year, Tom? Well, the Chinese Communist Party's made the decision for them.
Exactly. I mean, the rules have changed, and particularly I would focus on Hong Kong as well. I think it's a huge mystery into 2022 about, as you mentioned, Mr. Dimon, how the Western banks adapt and adjust to Hong Kong.
Tom, the greatest piece of arrogance, example of it, I think, over the last few decades, and a lot of people have echoed this sentiment, the belief that the Chinese Communist Party would want to mold China in the same way that we see the West look. And Tom, clearly that's not been the case.
There's no
they're going in their own direction, and it is too late, in some people's minds anyway, Tom, to do anything about it.
Yeah, there's no evidence now at all of that. And again, it's into year end, and it is, again, wrapped up in Omicron and all that. You know, it's going to be interesting to see how they react to the information flow on the virus as well.
We're still doing a Winter Olympics in Beijing.
That's John.
65 days away.
I mean, seriously.
Thank you, Kaylee.
And they're talking about maybe not going, attending, maybe boycotting it. What would have to happen to boycott it? We still can't get into China to get a review of how this all started. We still can't do that, apparently. From New York, this is Bloomberg.
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Your equity market shaping up as follows. From New York City this morning, good morning. Tom Keene, Jonathan Ferro, and Katie Lyons. We're down 33 and -0.7% on the S&P. The Nasdaq 100, -0.4. The Russell down about 1 full percentage point. We've been lower, we've been higher, we're lower again. One move, though, has been consistent. Friday, Monday, Tuesday. There are a few of them. Here's one. Switch up the board and get to the bond market. The front end of the curve. The bid in the 2-year sticks. Friday, Monday, Tuesday again, down 2 basis points to 0.4666%, Tom, going into Chairman Powell at 10 Eastern time.
Yeah, it's an improving tape. I mean, that's all there is to it. And the 2-year yield is saying, okay, we need to hear from the Fed, and they need to see the data. And we'll have this conversation in a moment, John, on 500,000 jobs created, another month of that on the back of 5 million jobs.
As we've said repeatedly through the morning, we've been pulling forward rate hikes, and now we're pushing them back and pushing them back over the last several days. That's the bond market. Let's finish on foreign exchange. Euro, dollar, TK, let's have a chat, a conversation about inflation in the Eurozone, 4.9%.
Yeah, Alberto Gallo, I thought, was brilliant on this, and he's basically saying, you know, resilient dollar, that's what we've seen, but at some point it's going to break down. And I thought Diana Moa was clear as a bell. EM doesn't move till you get dollar weakness.
Core has a 2 handle on inflation in Europe. But Kaylee, we got to talk about that meeting for the ECB, December 16th, the day after the Federal Reserve.
I'm not sure I'm working that day.
Well, Christine Lagarde and company have been very lonely for a while in that they have tried to stay persistently dovish, even as other major central banks move toward tightening. The question is, how long can they stay that way in the face of this inflation, especially with what I'm sure is some certain pressure from the Bundesbank, because we're talking 4.9 in Europe more broadly, 6% in Germany is the handle we got yesterday.
Yeah, that's something that upsets Germany in general, historically. Euro dollar 113.48. That's the cross asset price action. Let's get you some individual names, some stock movers, and say good morning to Romain. Morning, Romain.
Hey, good morning, John. Yeah, all the talk is still about Omicron and how that's going to affect the market here. Moderna shares down slightly here in the pre-market after CEO Stéphane Bancel tried to walk back some of the comments by his chief medical officer with regards to the timeline for when that company can develop a vaccine that could actually fight the Omicron virus. Of course, you're still talking about a stock that's up about 30+% here over the past 2 sessions alone. Travel stocks weaker once again. Expect Joe Biden to speak about this on Thursday to provide a more detailed plan for how he's going to address this latest wrinkle in the COVID pandemic. He did say pretty clearly yesterday that he did not anticipate any new travel restrictions. Nevertheless, American Airlines, which yesterday closed near a 9-month low, setting up here for what could be a 7th straight day of losses. JP Morgan and the rest of the banking sector down as well. A lot of eyes right now on Jay Powell. Of course, his testimony, the written testimony, is out. He did, of course, focus in on the downside risk. At least that's what the market is focusing in on. And, of course, the Omicron issue that's going to be talked about today at that hearing, that bumps right up against, of course, the next Fed meeting on the 15th, as well as the self-imposed deadline that Janet Yellen has flagged for the Treasury to run out of cash if the government doesn't raise the debt ceiling. So a lot going on here at 10 a.m. At the Dirksen Building down in Washington later today. A couple other movers here that kind of flew under the radar yesterday. A lot of the retail stocks really took it hard. Some of the preliminary data out of Black Friday and Cyber Monday not living up to expectations. Macy's setting up here for a second straight day of declines here. We should also point out most of the other names in this space like TJX, Kohl's, Nordstrom also lower as well. Square also in focus here, an upgrade over at Bank of America. A lot of the spotlight on Twitter because of Jack Dorsey's decision to step aside as CEO. They actually say this could be a net positive for Square.
Romain,
yeah.
You follow this. I mean, you're doing this on the close to a great effect. Which is a more prestigious job, CEO of Twitter or CEO of Square?
I think longer term, everyone would say probably Square without a doubt. But keep in mind, both of the companies that he's been running have been relative laggards, at least as far as its equity performance, including Square, while Square certainly outperformed Twitter. But if you're going to pick one, Tom, you definitely want to go for Square.
Okay, Romain Bostic, thank you so much. Greatly appreciated this morning. This is a joy because across the year, one of my themes has been our underestimation of technology and what Robert Solow would call technological progress. David Stubbs at JP Morgan was brilliant on this, 6 months ago or so. And we've asked back Scott Clemens, he's chief investment strategist at Brown Brothers Harriman, with just a brilliant essay here on our underestimation of technology. Scott, you get right down to the nitty gritty of a GDP that's moving up. You call it absolute GDP in a labor force. We're doing this with fewer jobs, at least within the mathematical soup of this pandemic. Do we have a new productivity?
Good morning, and I think we do. I think two of the very broad silver linings coming out of this otherwise horrible 20-month period of a pandemic-induced recession and economic dislocation is an acceleration in the adoption of technology, coupled with a greater utilization or a more efficient utilization of fixed assets, real estate being the primary one. Those are both productivity-enhancing trends. I think it's showing up in economic activity. To your point, we've got new record levels of GDP, absolute economic output, with 4.8 million fewer workers. I'm not sure that's sustainable, and that's closing, and we'll get more evidence of that with Friday's job reports. And at the same time, there's a greater utilization of things like real estate. Those fall to the bottom line of companies. Right. That's the real fuel for the equity market that we're seeing show up in corporate earnings and corporate profit margins.
I take real issues, Scott, with people that do a compare and contrast with the so-called dismal 70s. I didn't see the productivity enhancements there. How do you respond to people worried about these dynamics who say, oh no, it could be the 70s?
Well, there are a lot of differences with the 70s, policies being one of them. The other one that I think gets short attention is simply demographics. In the 1970s, a lot of what fueled inflation was a younger population still engaged in household formation and a lot of fundamental spending. Fast forward 50 years later, we're not as young as we used to be, neither you nor I nor the population, although we still look that way. But an aging population tends to spend less money and tends to spend it differently. And I think in the long run, that's a cap, a secular cap on inflation, although I readily acknowledge that the cyclical combinations of pent-up demand and disrupted supply chains are leading to inflation worldwide. It's not just here in the States, as you reported earlier.
Scott, that's the economic framework, and it's a wonderful economic framework. Just to frame things up and think about the economy, what does it mean for capital allocation, how you invest?
Well, Jonathan, we're still finding right now a lot of opportunities within large cap domestic equities. And I should say that we're active investors. So we're picking and choosing stocks within the market, not buying whole indices. When you see market movements like we saw on Friday or like we saw on Monday or like it looks like we're going to see today, a lot of that reflects a thematic trend either in favor of or against the so-called reopening trade. That obscures a lot of opportunities within the market. So within large cap U.S. equities and smaller cap U.S. equities, which tend to be more economically sensitive, we're still finding a lot of opportunities, but they tend to be below the radar screen of the large index moving mega cap stocks.
Are these small caps, Scott? Can you describe the characteristics a little bit more of them?
Well, Jonathan, they're sort of the kind of companies that actually facilitate the trends that we've been talking about, companies that are technology enablers, sort of forming the backbone of the kind of things that we now do as a regular basis on a day-to-day effort. And we also like companies that provide essential products and services. So non-discretionary consumer spending as opposed to the discretionary consumer spending, which is far more exposed to changes in consumer behavior because of the Omicron variant or whatever else might be confronting consumer sentiment.
Well, the Omicron variant certainly is confronting the equity market this morning, Scott, as it did on Friday. Would you be a buyer of any dips here?
I think we would be. And what we're seeing over the past couple of trading sessions is a useful and timely reminder that price volatility is a feature of markets. It is not a bug. It's just not a feature we've seen in quite some time. If anything, the relative absence of price volatility over the past 20 months, that's abnormal. That's the exception. We've had a bull market now since late March of 2020 without a single 10% correction. In a usual year, we have about 20 trading days in which the S&P index moves by 2% or more. So far this year, we've had only six. One of which was last Friday. So there are any number of things that could prompt price volatility. Omicron being the one today, the debt ceiling later this month, the continuing resolution, Build Back Better. There are any number of things that could create price volatility. As long as those underlying fundamentals of the job market, personal income, corporate earnings and corporate profit margins are headed in the right direction, that tide is still coming in. And yes, we would be a buyer of any dips.
Hey, Scott, just quickly, final question. Payrolls Friday, that data comes out. To what extent does that data still matter, given everything we're talking about at the moment?
I think it does, Jonathan, because the historical supports of economic activity, fiscal stimulus packages, emergency monetary support from the Fed, those things are beginning to wane. Going forward, we need to see a recovery in the fundamental supports like jobs and income driving personal spending.
John, I learned a lot in this interview with Scott Clemens.
Ditto, likewise, Tom.
I thought, the foundational idea from the gentleman from Brown Brothers and Harriman is that I'm not as young as I used to be.
He led with that too.
He nailed that.
He's welcome back anytime. Scott, thank you. Scott Clemens there of Brown Brothers Harriman.
Go away.
Tom, I keep going back to this payrolls report because I wonder how many people will be willing to de-emphasize the importance of it, given what we're discussing right now.
Look, it's Scott Clemens, and his note was brilliant, folks. And again, we protect the copyright. Get it from Brown Brothers Harriman. His note was brilliant, John. We have a productivity change going on. I don't know what it is. You know what my analysis of this, John, is in the jobs report on Friday?
Go on.
Drive up 3rd Avenue on your way up to get the surveillance nap. And it's completely lined with trucks and rentals, including U-Haul vehicles, piled up with cardboard boxes up 30 blocks. That's technology. That's the new productivity.
A road trip with Tom Keene, 40 blocks.
Yeah, well, one of the boxes at the Bentley the other day, and I was really upset.
I'm sure you were. 550, the median estimate this Friday. Kaylee, we've talked about that range. 800K at the high end, 375 at the low end.
And it's a really interesting point to consider how much this number does or does not matter. Of course, it comes less than 2 weeks ahead of a Fed decision, John, but given all the concern around the Omicron variant, does progress in the labor market and high inflation mean as much to the Fed with that kind of uncertainty out there?
I did not think we'd be talking about this in November 2021 when we kicked this off 18 months ago.
John, do you see how Kaylee ignores our humor, unlike Lisa? She just ignores
it. Shrugs it off.
That's not
she
true.
Just,
I laugh at you, Tom.
Learning quickly,
Yeah,
Tom.
I noticed.
just to ignore us. Coming up at 8:15. As I was saying, I did not think I'd be saying this 18 months ago.
True.
We need to talk about the pandemic still.
Yes.
Lawrence Sauer of the University of Nebraska Medical Center joining us a little bit later in the next hour. From New York City, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Financial markets appear to have been spooked by comments about the Omicron variant from executives at Moderna. CEO Stefan Bancel told the Financial Times that new vaccines will be needed and they will take months to develop. On Bloomberg TV, Chairman Noubar Afeyan said that we have to take the new variant for the serious threat it poses. In China, manufacturing rebounded in November after a power crunch subsided and price pressures eased. The Manufacturing Purchasing Managers Index rose to the level that signals an expansion in production. That is the first time that has happened in 3 months. a warning from SpaceX CEO Elon Musk. According to the website Space Explored, Musk says the company could face a genuine risk of bankruptcy if it cannot launch one of its Starship vehicles at a rate of one every 2 weeks next year. The website quoted from an internal email. Musk said production issues with Starship's engine are worse than they seemed just a few weeks ago. And one of my favorite golfers, Tiger Woods, has admitted that his days as a full-time pro golfer are over. Woods suffered severe leg injuries in a car crash last February. In an interview with the Golf Digest, Woods said he could see himself playing in occasional tournaments, but he wouldn't return to tour on a regular basis. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Lini Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the quarter three was the quarter that was most affected.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
third year coming off a bear market or low, it's harder. The market doesn't do as well. And that's because financial conditions start to tighten. A lot of volatility around a single-digit year. So I suspect that next year is going to be a tougher year to make money.
Next year is going to be a tougher year to make money. The message from Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. I've got to say, far less constructive than he's been through much of this year. From New York City with Tom Keene, I'm Jonathan Ferro, together with Katie Lyons. Lisa back with us tomorrow. Your equity market recovers a little bit, still down 44 and negative 0.9%. Let's call it down 1%. There's a bid where you expect there to be a bid. Yields are lower by 6 basis points, 143.92. Treasuries are firmer. Euro dollar 113.53. Inflation in the Eurozone close to 5%. And crude negative 2.63%. Tom Keene, $68.12 on WTI.
Yeah, it's sort of a churning tape here. I'm waiting for the economic data really clicking in tomorrow as well. It is widely known, and we're going to start a two-day celebration of David Wilson, who wanders out the door tomorrow. He bought oil with Lisa Abramowitz, and he said, I'm retiring. and David Wilson with us, and this starts with the heritage of Matt Winkler starting Bloomberg News off a Rolodex on a wooden desk. David Wilson started the equity team of Bloomberg with Tim Quinson and Scott Schnipper in London, I think. It was like three of you commanding the equity world, wasn't it?
Yeah, that's about all it was. And, you know, one of the things I remember when I moved on from stocks and started doing company coverage, you'd call people here in New York and they tell you, oh, sorry, we don't need any forms, because they thought Bloomberg was an office supply chain called Blumberg. So just goes to show you how things have changed over the decades.
Very quickly here, I want to get to your chart of the day, but the basic idea here, David, is old folks like me read the back page of the Wall Street Journal to get our corporate coverage, and really Bloomberg, with some other media, but you and Matt Winkler invented corporate coverage before the earnings, on the earnings, and after the earnings. What was it like when you started that?
Well, I mean, it was a whole different universe in a sense, because you didn't have the depth of corporate data on the terminal that you did now. I mean, you know, we hired 25 reporters and started out with a small company bureau in Princeton.
Right.
That was really the
and
focus.
You had sawdust on the floor and cigar spittoons in the corner, right?
Well, actually, it was more like no carpeting on the floors and air conditioning ducts hanging out of the ceiling when we started. I mean, we spent 8 weeks training these journalists because we had no place to put them.
You spent 8 weeks on the chart today. What do you got?
Well, I mean, it's really a carryover from yesterday in a sense. You know, Jack Dorsey leaving Twitter, giving up his CEO position. Of course, he'd run Twitter as well as Square for the last 6 years. It worked out great for Square shareholders. For Twitter, not so much. If you look over his entire tenure, I mean, he became interim CEO in June 2015. He took over for Dick Costolo, and then the interim was taken off his title a few months later. But you go back to June of that year, 2015, you find out stock was only up 31%. And this is at a time when you look across the NYSE's FANG Plus stocks, where you find Google's owner Alphabet as well as Facebook, I mean, direct competitors of Twitter, up 6-fold. And then you look at Square. You know, at one point it was up 30-fold over that period. Now it's more like 22, but still, I mean, such a contrast in performance here. You can only hope, if you're a Twitter shareholder, that their new CEO is able to deliver better for stockholders than Jack Dorsey ultimately was able to do.
And Dave, the issue isn't that people aren't using Twitter. They are, and to a larger degree as time goes on, and yet it's just not reflected in the share price.
Yeah, and the challenge is generating revenue. I mean, they've started this service called Twitter Blue. In essence, you can get some extra bells and whistles as a Twitter user. That's one way they're looking to make money. And so, you know, that's the challenge. And how well is that going to do? And, you know, advertising, I mean, you figure they're up against the likes of Google and Facebook when it comes to driving the ad dollars. And there's a lot of competition for that. And it shows up in the stock's relative performance. You know, you look at even Pinterest has doubled in the last 2 years, and Twitter hasn't even been able to keep up.
You know, Dave, we can rely every day on you tweeting out your chart and stock of the day. What's the retirement act? Are we still going to get those picks? Is it going to be song of the day? What is it?
You know, it's an interesting question. In fact, I think we're going to be able to keep up chart of the day with Kriti Gupta, who's taking over much of what I've been doing.
She drank the Kool-Aid?
I hope so. I hope it, you know, kind of, you know, needed what it, you know, it delivered what it needed to be. I don't know. In any case, so we'll keep up some of that. Some of that may, pass into history. We'll see how it all shakes out.
Pass into history. David Wilson will be with us tomorrow, where we'll pass into history. He's our Bloomberg stocks editor.
Dave, thank you.
David, thank you. We'll see you tomorrow.
A celebration of Dave for the next 24 hours. Tom, this came from Jeff Green of Bloomberg. Parag Agrawal, 37, the youngest CEO in the S&P 500 now.
Interesting.
Zuckerberg born earlier. He was born earlier than Zuckerberg in 84, so Zuckerberg now in the second spot.
Interesting. I don't have any real wisdom on it. We use Twitter like crazy. It's been a huge benefit to all of team surveillance. But John, I don't understand their revenue production, as I don't understand the revenue production of a lot of other things.
Well, most people would say, Tom, they don't understand how this hasn't been a massive success, how it's missed out on a 10-year bull market in names like Twitter, given that the president was the main attraction on it for much of the last 4 years, Tom, and still just couldn't make it pop.
And I've done this, John, in lectures, actually, where people have asked me about this. I did a thing at CCNY, with Jeff Jarvis. I remember David Gregory was at NBC, and he found this thing called Twitter. I had no idea what it was. And he just jump-started, David Gregory, with that one newspaper article, jump-started so many people in news. And even then, it took 2 or 3 years before it really got a critical mass.
It's become a home for journalists, but the special moments take place between the likes of Senator Sanders and the likes of Elon Musk, Kayleigh. You've got to be able to make money from those kind of things.
Well, and Twitter has to a large extent. It just hasn't been able to monetize on all of it. I would also say Twitter's kind of taken a harder line with some of the political aspects of social media. They don't allow political advertising on the platform. They've been a lot more strict with flagging tweets, with blocking them. We saw that happen with President Trump. And I wonder how much of that was Jack Dorsey, who has been quite open about his opinions on things, and if that kind of model will change as we move forward under a new CEO.
The stock yesterday closing just a little bit lower this morning in the pre-market, up 0.75%. Your broader market, let's take stock of things. Futures are negative 43 on the S&P. We're down 0.9%. A little bit of risk off. That theme, Tom, is bleeding through this market worldwide. Cross-asset yields in 6 basis points on 10s.
What are we waiting for? I mean, are we waiting for like a research report from WHO, or I don't know what we're waiting for within this fear that we all have.
On this one specific variant, 3 things, Tom. Transmissibility, severity, and vaccine efficacy. Those 3 things. We want detail on all 3. And it's going to take a couple of weeks to get a really full picture of those things.
I'm going to put at the top of the pile, John, vaccine efficacy, as you call it. And the answer is get a booster shot. If you haven't gotten vaccinated, hold somebody's hand and get the first shot on your way to the second shot.
Are you willing to walk people over, Tom?
I am willing to walk people over.
And hold their hands?
Absolutely.
Okay.
Yeah.
I'll run through the price action again for you. Coming up, Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Looking forward to catching up with Victoria in about 10 minutes' time. As we work through the price action, we are negative 0.9% on the S&P. Yields are in 6 basis points on 10s to 143.75. And crude is negative 2.8% to 67.97. From New York with Tom Keene, I'm Jonathan Ferro, together with Katie Lyons. A beautiful one in New York City.
years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels.
There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The virus and the evolution of the virus has shaped everything in the course of the past 18 months.
The Fed put should be questioned when you have inflation.
Any step back from the current policy path is really going to be scrutinized.
By the time you get to the back half of 2022, things will look very different.
I think there's much bigger issues next year than COVID.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Kaylee Lyons in for Lisa Abramowitz this morning. A simulcast on radio, on television. John, the president travels near Minnesota, Dakota County, where cases have gone from a summer of 6 up to 271. He has to continue to address this pandemic around all that we see in the markets.
And just like us and everybody else, he's got to wait, Tom. He's got to wait for data. I'm much more comfortable sounding like a broken record than layering speculation on top of speculation and injecting some hyperbole into the situation, Tom. We want to know how severe this disease is. We want to know how effective the vaccines are and how transmissible this variant is. And Tom, until we get the data, a clearer picture over the next couple of weeks, I don't think we can draw firm conclusions on anything.
I like what Andrew Slaney said there in the morning from Morgan Stanley there in the opening comment, John. He said there's more going on here than Omicron. We've got jobs report on Friday. And more than that, we've got the set piece for 2022. There's a mystery.
And we've got Chairman Powell a little bit later this morning, 10 Eastern, a decision on December 15th. And a chairman, Tom, who is very much stuck between a rock and a hard place. Inflation is hot. We've got downside risk to growth coming from this variant. We can't fully appreciate how pronounced those downside risks are, and we may not be able to do that until that Fed meeting.
Kaylee Lyons, what will you listen for from Chairman Powell?
Well, it's just that balance of the dual mandate between what is happening in the labor market, if it is getting closer and closer to meeting the Fed's criteria of maximum employment, as with the inflation question, which I'm sure lawmakers will be pressing the chairman on, and how much does Omicron cloud that outlook, or how much can the Fed even know at this point, given all we don't know? That is the question.
We know on radio and television, you follow us for our reading of the research, our team's reading of the research, and John, the outlier entire piece that everyone is talking about off the London desk of JP Morgan, Christian Balick, with the team over there talking about a sustained $80 a barrel with potentials out well over $100 a barrel. They look at spare capacity, and it's just not there in this underinvestment in CapEx in oil.
Right now, just north of 68 on WTI, and we correct lower. Tom, I'm going to whip through the price action just quickly. Crude down 2.6%. Equities off by 39 and negative about 0.8%. It's the story of the bond market that keeps getting our attention, though. Yields aggressively lower Monday, down 15 basis points. They bounced back, down 15 on Friday, rather. Yesterday, they bounced back. This morning, lower again by 6 basis points to 143.92. And we keep talking about this volatility on 10s. Let's just talk about the last 3 days on 2s. Aggressively lower Friday, lower again on Monday, lower again this morning by 2 basis points to 46, and something we've repeated several times through the last few hours on this program. The last few months has been about pulling forward rate hikes. The last few days, Tom, has been about pushing them back out. Chairman Powell on deck. A crucial conversation with the chairman, I think, Tom, given what we've seen in this bond market recently.
Yeah, in the bond market, and John, let's focus right now. Let's go back an hour, folks. And for Global Wall Street, there's all sorts of pieces of the bond market to talk of. But John, I like what you say at 0.47% of the 2-year yield. I mean, that is the litmus paper of the system right now.
It was almost 20 basis points higher last week, Tom, at around 65 basis points. The conversation was very, very different going into that Friday session. And has it changed that much? What was new overnight? What was new in that interview with the Moderna exec in the Financial Times? What was new about that? And I think a lot of people waking up this morning saying, I don't know either, maybe nothing.
We got an advantage now. We go to Houston, Texas. Victoria Fernandez has the advantage. She gets to work with Robert Dahl, which is always a wonderful thing, Chief Market Strategist at Crossmark Global Investments. Victoria, if we get a JP Morgan 80 or 100 or 110, whatever, dollars a barrel, you're hardwired to this in Texas. What does it mean for America if we get a sustained higher oil price?
Well, I think you have twofold here, Tom. I mean, obviously, for the energy companies, they've been looking for these prices to go higher. They need that revenue to go ahead and put that CapEx in that you guys were just talking about. But we're talking so much about inflation and the effects that it's having on the consumer and what that's going to mean. Obviously, that is where a consumer feels it first and foremost, is when it comes to oil. I think we have a lot of concerns here as to what OPEC Plus is going to do. We're going to hear from them later this week. So we'll see what plays into that, along with releasing from the reserves. So I think there's a lot of balls in the air when it comes to energy right now. And just like we're talking about the variant, we have to wait and see. Same thing's going to happen with energy.
Your clientele is a great cross-section of people out there working at it every day. They've made a pot of money, whatever, and they go see Crossmark. I get that. How scared are they of Omicron? How scared are they of 2022?
You know, it's interesting. I think this morning, and obviously I haven't talked to clients yet this morning, but I think we might hear a little bit of a different tone. You hear Powell coming out and using that word uncertainty. We know the markets don't like that word, so that's going to add some volatility. You have the Moderna CEO coming out and saying that things are not going to be good. That's going to feed into the psyche of the consumer. We've talked many times about how we think the consumer is leading this economy right now, and that strength of the consumer we need to rely on. So I think there's going to be maybe a little bit more concern from an investor perspective, but I think that's where my job comes into play, where I need to tell people, take a step back. As you guys have said all morning, we don't have the data yet. Let's not change our outlook and our strategy until we know more.
Victoria, I just want to pick up on something the chairman said in that pre-prepared statement ahead of his testimony later, and you picked up on that word uncertainty. The recent rise, and here's the quote, in COVID-19 cases and the emergence of the Omicron variant pose downside risk to employment and economic activity. That's well understood. Then he said this, an increased uncertainty for inflation. What do you think that actually means, increased uncertainty for inflation? Does that mean upside risk to inflation? Does it mean downside risk too? What does it mean?
I think it's actually an upside risk at first, because it's adding to that whole, and I know we hate to use the word, but it's adding to that transitory component. If supply chains do not improve. You know, we talked a couple weeks ago and we were saying we think we might be at peak supply chain issues. We started to see shipping costs come down. We started to see a little bit of pressure being relieved at the ports. If the variant now causes people not to go to work, it causes restrictions and shutdowns, all of that's going to ramp up again, and that's going to lead back into how much of this is transitory? What are we looking at for inflation? So I think it's an upside concern in the short term. Longer term, I think we're still looking at inflation coming down next year to around 3%.
So how do you position then for the medium and longer term, Victoria?
Yeah, so Kaylee, what we told our clients before last week and what we're going to continue to tell them for now is that we need to have that balanced portfolio. We like those growth, those tech names that are in there, and we don't want to get rid of them, but we could trim those and build a little bit more on the cyclical component of our portfolio. Some of those consumer-facing names that here in the fourth quarter would traditionally do well, and we think they will once we get past the initial reaction of this variant. So names we've added like a CVS, a Walgreens Boots we've added, Lululemon, even a name like Prologis, which is a REIT in regards to logistics for shipping. So I think you can start looking at some more of those cyclical names to balance out your portfolio, especially when you see the credit market still holding pretty strong. That's a bullish signal for us.
Victoria, great to catch up. As always, it's good to see you. Victoria Fernandez there of Crossmark on this market. Here's a call for you on this Federal Reserve. This comes from Robert Burgess out on Twitter, releasing some of the calls from Bloomberg Economics. Tom, here's the call for you. Quote, we expect the Federal Reserve to announce at its December meeting an acceleration in the pace of asset purchase reductions. The pace of the taper is likely to double starting in January, in line with some other calls out there, Tom, going into this decision on December 15th. And after we heard those comments from Vice Chair Clarida, Governor Waller, Presidents Daley and Bostic also raising a prospect of making that decision later that next month.
And how do you get there, John? You get there Friday at 8:30 if you top out with revisions, 550,000 jobs, and the unemployment rate goes from 4.6, survey 4.5. Can you imagine, John, 4.4 or 4.3?
That's what I'm trying to get my hands around, Tom. Yeah. To what degree does that payrolls report move the dial this Friday? If we're all waiting for the data we need to see to work out what this variant actually means for this economy, for the world, Tom, for society, if we've got to wait for that, do we have that in hand by the time we get to that meeting? And then do we look back to the payrolls report and say, okay, now we can take on the importance of what that means?
I'm going to partition it, John, and say with great respect to the suffering of all in the pandemic, the financial world's just going to look at the economic data and see a buoyant economy and an improving labor force.
And then they're going to look forward, Kaylee, and try and work out whether this variant changes the outlook.
I wonder, too, if it's the data that the Fed is going to depend on is the economic data that we get already and is tangible, not the unanswered questions around the variant, because the Fed has said time and again, we're going to react to what is actually there empirically. So if you're having the labor market recovery continuing to make progress, we know inflation is running hot. Does that mean that the Fed maybe does think about accelerating the taper in January and then dealing with the variant later once they have more information?
Okay, well, let me ask you this question. I'd like to put it down to a question. Tom, it sounds like this. If you're Chairman Powell right now, and you can only have one thing out of two, you can have the labor market report on Friday, or you can have vaccine efficacy data for this variant. Which one do you want on December 15th?
You want both, but the answer is, John, is of all the pandemic stuff we're talking about, vaccine efficacy is the heart of the matter. Every adult we've talked to in science has said we got to move from 59% up. Hotez yesterday of Baylor was heated. No, not 60%, 70%. We got to get to 80+%.
85. I heard that. Great interview, Tom. Tom Keene, Jonathan Ferro, Kelly Lyons this morning. Lisa back with us tomorrow. Your equity market down 42.
So
we're negative 0.9% on the S&P 500. If you're just tuning in, there is a bid in the bond market. Yield to lower again. Lower Friday, higher Monday, lower Tuesday, down 6 basis points to 144. And crude heading south, down 3%, a 67 handle on WTI. This is where the administration wants crude to be heading, but maybe not for this reason. 67.75 on crude. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The top executives of Moderna say the world may need new vaccines to fight the coronavirus Omicron variant. Chair Nufar Afeyan told Bloomberg TV the number of mutations on the virus are surprising. CEO Stefan Bancel told the Financial Times it may take months for drug makers to develop and deploy updated vaccines they can deliver in large numbers. Now, GlaxoSmithKline has made a trophy hire. The British drug maker has lured a senior Pfizer scientist who helped develop the company's coronavirus vaccine. Phil Dormatizer will now oversee Glaxo's vaccines research and development. Federal Chair Reserve Jerome Powell has weighed in on the new variant of the coronavirus. He warns that it poses risks to both sides of the Fed's mandate to achieve stable prices and maximum employment. Powell's remarks came in a testimony prepared for an appearance before the Senate Banking Committee later today. Meanwhile, oil is headed for its biggest monthly loss since the early days of the pandemic. Crude has slumped almost 20% in November. Investors are now seeking clues about the challenge posed by the new virus variant and how producers will respond. OPEC and its allies will decide on Thursday whether to halt a run of monthly production increases. Electric vehicles will account for about half of auto sales in the world's major markets by 2030. That's according to a new survey of auto executives by consulting firm KPMG. EVs make up less than 10% of global sales right now, but executives project that will increase, and that will be driven by battery-powered models reaching a cost equal to cars powered by internal combustion engines. This is Bloomberg.
Young woman that's watching this wants to be the next Diane von Furstenberg, what would you recommend?
Be as true to yourself as you possibly can. The more you could be you, the happier you will be.
How does an extra $1 trillion in spending not increase?
Part two of the president's agenda, what I like to call the big deal. But part two of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We need 85% of the U.S. population vaccinated. And we've got this horrific situation in the United States where since June 1, 2021, 150,000 Americans who refused vaccinations needlessly perished from COVID-19.
Dr. Peter Hodes there, the Dean of Baylor College and National School of Tropical Medicine from New York City this morning. Good morning. Tom Keene, Jonathan Ferro, together with Katie Lyons. Lisa back with us tomorrow. Your equity market down 40 on the S&P, negative 0.9%. The market's softer off the back, according to some people, of an interview from the Moderna CEO with the Financial Times. Does it move things along much? I'm not so sure about that, and neither's Tom or Kaylee and many others you as well. Yields are down by 5 basis points to 144 on 10s. Crude is lower by 3 percentage points to 670, 67 rather, 80, 67, 80 on WTI. This came from Anna Wong, our chief US economist at Bloomberg Economics, out moments ago with their outlook piece, Tom. The pace of taper is likely to double starting in January, with the process finishing in March. They go on to say this could open the door, to a rate hike as early as March if possible inflation risks materialize.
Now, the different opinions that are out there that make surveillance go, and John, you got to believe, I'm sorry, this jobs report has been underplayed because of Omicron, but I'm sorry, the jobs report is a really key piece of data.
Going into December 15th, Tom, your next big stop, year over after that week, I think, Tom, the 15th, 16th, those 2 days.
You know, you're going to have the car idling here for the
after the Fed, after the ECB, after the president's news conference.
I'm not sure
I'll come in on the Thursday.
Yeah, Lagarde called me yesterday and said, "Are you going to be here on the 16th?" And I said, "I don't know. You know, we'll see."
Do you want to share what else you might have talked about?
No, you know,
just are you going to be in?
She has a tree, small. It's not as fancy as your tree, John. That's what she.
I'm sure it's fancy.
Chanel ornaments.
Yeah, can you imagine?
Yesterday was a magical day for us within the stress of Omicron to speak to Peter Hodes and the good people at Johns Hopkins as well. And what it's about is the dispersion of our intellectual capital, with Hodes going from Rockefeller University down to Baylor College over the years, or Lawrence Sauer of Johns Hopkins going out to Nebraska to the first-rate program at the University of Nebraska Medical Center. And this is really serious adult stuff about special pathogens, like think Ebola as well. Lauren, you are looking at an unvaccinated population. My working number is 13 times greater death. Is Omicron a special pathogen that will get this nation vaccinated?
When we think about special pathogens, we think about the tools in our toolkit that allow us to treat, to manage, to save lives of the patients who get the special pathogens. And I think right now we're still waiting to see what's going to happen with the vaccines around Omicron. We know some of our tools work, our tests still work, we know masks still work, a lot of our treatments will still work on Omicron. And we may need boosters to improve our ability to protect people against this new variant. But I think right now we can say that getting your vaccine is still critically important.
An unfair question, but do you, within all your resources, including back at Johns Hopkins, do you have a timeline of when we'll get these answers?
I would guess we'll see updates on the vaccine in the next couple weeks, science updates, understanding how the vaccine will affect how the variant will affect the vaccine efficacy. And then I would say we could see new approvals for a vaccine if it has to be updated in the next few months. So I would say somewhere between 2 and 4 months, we'll see updates to the vaccine. Science is working around the clock, and it's really incredible how fast these changes are happening to manage the changes to the virus that we're seeing.
Well, and Lauren, we've seen the virus change before. We have been here in a similar moment before. We maybe are still in it with Delta in many places. What stops the cycle of this happening again and again?
Just like Dr. Hota said yesterday, getting that vaccine rate high. As many people vaccinated as possible is critical to stopping and slowing down these new variants. So the variants move through unvaccinated populations easier, and when we start to see them appear in populations with lower vaccines, they can also move out of those populations quicker. So getting as many people vaccinated as possible is huge. I agree with him. I'd love to see 85% here in the U.S. Not only does it protect against the variants, but it also protects against the already circulating strains and reduces the likelihood of severe disease and death. We are seeing unnecessary death. We're seeing unnecessary strain on our hospitals and healthcare systems and on our healthcare workers in particular.
Well, Lauren, it's not just about vaccinations as well. It's also about the treatment of people who do end up testing positive and getting sick. Do we know anything about the effectiveness of treatments? We know that vaccine efficacy can change depending on the variant. Does treatment as well?
As of right now, it's looking like our treatments will still be useful. We still have incredible supportive care here in the United States to treat and take care of patients who make their way into the hospital because of COVID. And the newly developed treatments look like they will continue to work against Omicron, which is great to hear. It's great news. We are still seeing the development of new therapeutics coming down the pike, and those developments will continue to happen even as new variants pop up. For now, those tools still work for us, and the hope is that we'll keep people out of the hospital as the vaccines evolve and develop.
Lauren, your observation on migrating from the East Coast out to Nebraska with a 1.9% unemployment rate. What is your observation on Omaha, Lincoln, and the rest of it out to Cozad and beyond?
I love Omaha. I mean, I'm so happy whenever I'm there. It's a fantastic city. And I think that one of the things that we're seeing is that the hospital and healthcare utilization of people getting COVID is still really high. So we would like to see higher vaccination rates in Nebraska as well. And it is a different environment, obviously, than Baltimore. I still live in Baltimore, so I get a flavor of both. But we'd love to see increased vaccination rates in the more rural areas of Nebraska, in the city, and through the support of UNMC, there's big pushes to get more people vaccinated every single day.
Lauren, it's been too long. It's always good to catch up with you. Lauren Souther of the University of Nebraska Medical Center, thank you very much. A headline I want to bring to you very quickly. The White House to provide updates on COVID-19 efforts today, Tom, 12:30 Eastern Time.
Well, it's a lead message for the president. Maybe it's the one message that's really, really working for him right now. John, I believe, and I don't have the schedule in front of me, but somehow that's dovetailed in to his trip to Minnesota. This is just below central Minneapolis. At the Dakota Technical College, I believe, where he'll do the infrastructure message. But I'm really not surprised to see that, John. It's the one thing he's been winning on.
What are we looking for him to say, though? Kelly, what does this administration need to do?
The same thing we heard from Moderna.
That hasn't been done already.
Maybe more clarity that we don't know anything. Maybe he pushes back on what we heard from Moderna overnight, that it would be a substantial drop in efficacy or a material one. Maybe he just tells Americans not to panic, although he kind of did that yesterday, didn't he, John?
I find the comments from Moderna, the reaction to the comments, not just the comments alone, but the reaction to the comments, just bizarre overnight, Tom.
Well, maybe he'll come out and clarify. I mean, CEOs can speak out of turn.
Well, bizarre, Tom, because we'd heard it so many times through the day.
Yeah.
The message itself wasn't new. We still need to wait for the data. It's highly conditional still in many ways. Highly probable. You like that, Tom?
I love that. Oh, I love that. Double probable. Adverbs.
Helpful.
Talk about clarity.
Futures down 43 on the S&P, negative 0.9%. On TV and radio, this is Bloomberg Surveillance.
对我们军方来讲的话，我只跟委员报告，是我从军以来40多年以来看到真的是最严峻的时候。要翻台的话，他目前有这能力的，都有的啊，但是要看怎么一个结局。所以我们不做任何挑衅啊，但如果把他激怒了，就跟我们人一样，你把我激怒了，我手上能力我也会发挥出来。所以2025是我们研判要全面啊，我们这样研判的。
China has, I've spoken with Xi about Taiwan. We agree we'll abide by the Taiwan agreement. That's where we are. And we made it clear that I don't think he should be doing anything other than abiding by the agreement.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Lini Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
It's a tougher session than yesterday for the equity bulls. We're down 43 on the S&P. We're negative 0.9%. Treasuries getting that bid off the back of that risk aversion. Yields lower by 7 or 8 basis points to 142.23. Going into Chairman Powell at 10 Eastern time, and then a Fed decision on December 15th. This coming from our team at Bloomberg Economics, the chief U.S. economist, with their outlook piece. Anna Wong saying the pace of the taper is likely to double starting in January. The process wraps up in March. It would open the door to a rate hike as early as March if upside inflation risks materialize. The outlook, Tom, from Bloomberg Economics this morning.
Yeah, part of the ballet of the central banks. And when do we see Chairman Powell, John? Is it 10 p.m. or is it later?
90 minutes time, Tom.
90 minutes time as well. This is a joy. In studio with us, Ian Shepardson, chief economist at Pantheon Macroeconomics. And what's so important about his focus on the United States is also the Pantheon Macroeconomics expertise on China. Craig Botham doing that this morning in China. His morning note talks about the infrastructure push of China, and you clearly see a better China than the gloom that's out there.
Well, yeah, some of the gloom is quite extreme. China's got some really big problems, but it's not, the end of the world. The loss of the real estate-driven model for growth that they've had for so long requires a shift into other areas, and infrastructure is clearly going to be one of them. So it's very early days, and obviously the real estate problems continue to roll on. This is going to be with us for a very long time. But China does have to find a different growth model to carry it through now that it's lost that impetus from real estate.
With your wonderful perspective, I think of only Leland Miller at China Beige Book, who really has that dynamic going back and forth across the Pacific. How does the Chinese dynamics domestically affect your watch of the American economy?
Yeah, it's a problem for us in the U.S. because of the disruptions that are caused by China's zero COVID policies. So it disrupts our manufacturing, disrupts our logistic chains, disrupts our ports. And of course, with Omicron, potentially they'll clamp down even more. China doesn't show any signs of stepping away from that zero COVID approach. And that means endless supply disruptions and supply chain problems for U.S. manufacturers and businesses seeking to import components or finished goods from China. So I don't see this going away. It's primarily a problem for the manufacturing sector. it's not the whole U.S. economy which is enthralled to the problems in China, but it's certainly not helpful at the margin, and the Omicron cloud makes things even more difficult to see ahead.
And that word endless is very different to the word that's been used all year, transitory. So I just wonder, a simple question, does the chairman have the time to wait, to sit this out and wait?
I think he does, if he gets ahead of what's coming over the next few months and preps the markets for what's likely to be some really horrible inflation figures for November, December, January. Then things start to get better. But at the moment, the Fed kind of seems reactive to these numbers rather than getting out front and saying to markets, hey, it's going to be bad, it's going to be worse. We might even see core inflation at, I don't know, 6.5% potentially in February. Then it drops very sharply. But it's a question of whether the Fed is prepared to dig in its heels and say, we're going to wait for the turn because we know it's coming, or whether they feel that they have to respond, maybe to take out something that they would call an insurance policy against transitory becoming more embedded. That certainly seems to be the way that they've gone with the taper. And if it weren't for Omicron, I'm sure they would be doubling the pace of the taper at the December meeting. Now there's some uncertainty over that.
Do you think they need to do that, Ian, to retain that optionality on rates? Do you think they need to go quicker?
I don't think they have to, because I'm really quite bullish about inflation in the medium term. I very much buy the idea that by the end of next year, we're going to be looking back and saying, really, what was all the fuss about, especially in the goods sector, where I think we'll see a really dramatic turnaround. But the Fed can't necessarily assume that that's guaranteed to happen. And that's where this question of taking out an insurance policy, giving yourself some more room for maneuver just in case you're wrong, becomes a more pressing question. And if it weren't for Omicron, yeah, they'd taper sooner, and that would open the door to a rate hike at some point in the second quarter, maybe as soon as March, so that would surprise me. I do think that there's still a substantial body of opinion within the Fed that thinks that they need to give it some more time, that they're pretty confident that the labor market is going to fix itself with rising participation over the next few months and ease some of that wage pressure. But of course it might not. And if it doesn't, then you're looking back saying, well, we should have been a bit more aggressive. So there's a real balancing act to be made there. Right now markets have got a pretty firm view of the way the Fed needs to go, but I'm not sure it's quite so clear-cut yet.
Ian, does maximum employment, that part of the dual mandate, not need to be redefined for a pandemic-era economy?
Well, this is a tricky one, because they've never defined maximum employment in very explicit terms. So do they mean that the unemployment rate getting back to 3.5 like it was before COVID? Do they mean the employment population ratio returning to where it was before COVID? Do they mean the participation rate going back to where it was before COVID? They've never really said, but I think that it's important to appreciate that Chair Powell has been very keen for a long time now about reminding people how good the labor market was before COVID and how much he wants to get back to something that looks a lot like that before he would consider the full employment mandate to have been reached. Whereas some of his colleagues, I think, are a bit more gung-ho, probably because they're more nervous about the inflation outlook than Mr. Powell is. And there's a very split opinion on the Fed, and of course we've got empty seats that need to be filled over the next few months, so we may well see the balance of power shifting, I think, in favor of the doves in Washington and maybe away from some of the more hawkish regional people.
Well, if you game this out and take what people have said, the potential implications of the Omicron variant, again, there's things that we don't know, but if you have it exacerbating supply-side challenges, feeding into those inflationary dynamics, at the same time, it maybe discourages people from re-entering the labor market. Will the Fed end up in a situation where it's forced to react to inflation, even if the labor market's not where it wants to be?
Yeah, this is now a real risk, that if Omicron keeps people out of the easing this supply-demand imbalance that we've got right now with very, very high wage growth. If Omicron stops that imbalance being shifted in favor of more supply, then the wage numbers won't slow down in the way that the Fed needs them to, and they'll be pushed into being more aggressive. But at the moment, this is very premature. We don't know. We may find out over the next couple of weeks that this is a great deal of fuss about not very much, in which case we're back on the previous track. We're all speculating right now, and the message coming out of the Oxford vaccine people is different to the message from the Moderna vaccine people. So nobody really knows. And I do think that the Fed has maybe a bit more time to deal with this than some people in markets think. I don't think the US is on the verge of some sort of sustained inflation explosion. I think patience is a virtue in central banking most of the time.
Well, the patience is the key question, and Ian Shepherdson, what it comes down to is ex ante, ex post, and the Latin is they're going to wait for the data. They're just going to wait and wait. How much does the street right now, just as a general statement, underestimate their ability to go ex post and to wait?
Well, a lot. You know, markets,
to me, it's a lot. Yeah, it's massive.
Markets are very gung ho. Markets always want things to change because volatility is where they make their money or lose their money.
Exactly.
And the Fed, however, is not conducting policy on the basis of what might make people more money in markets. It's conducting policy on the basis of what's in the national interest. And I think there's a strong case to be made for waiting. See how the labour market pans out over the next few months. Most of the structural impediments to rising participation have diminished now. Schools are reopened, childcare is reopened, the extended benefits are all over. COVID fear until Omicron maybe was fading away. So it's very reasonable to think that we're going to see a big rush of people back into the labour force and ease some of those pressures. And if the Fed, turns out to be wrong and those pressures don't ease, well, they've maybe lost 3 or 4 months, which I very much doubt would be a medium-term game changer. And I think it's also important that people remember that using monetary policy to deal with something which is driven by a shock, the COVID shock, is the wrong response because policy works with a 12 to 18-month lag. That's far longer than the time frame that I think is reasonable to expect some of these COVID shocks to diminish. So you end up doing something which proves to be a mistake, unless, of course, you're wrong and those labour market pressures don't go away. But at the moment, it's too early to make that judgment, and I think they have more time than markets want to believe.
I don't want to drown in semantics here, but I do think the following is important. Ian, isn't there an argument that actually now they're more forecast dependent than they are data dependent? That if you think about it, what they are relying on is their own forecast. The data itself, the incoming economic data, is already telling them that they're wrong, and they have been wrong.
Well, certainly the current inflation rate and the inflation rate over the next few months is going to generate a lot more horrible headlines. There's no question about that. But of course, it's not the job of monetary policy to try and fix today's headlines or tomorrow's headlines. It's the job of monetary policy to fix the headlines in 12 to 18 months' time. Now, sometimes today's headlines carry a lot of information about what they're going to look like in 12 to 18 months' time. But if you've got a shock rather than an economic cycle that's generating the inflation numbers, then it's different. And it may well be that today's headlines are a terrible guide to what inflation will look like in 12 to 18 months' time, and therefore you shouldn't use them to drive policy. But the problem, of course, is that if you're wrong, then you find yourself in a much worse position in 12 to 18 months' time, and you have to scramble to catch up to do what maybe you should have done much earlier. But we don't have perfect foresight. We have a great deal of uncertainty, and I think they can afford to wait a little bit longer.
Are you talking about Newcastle?
Yeah, I'm trying not to talk about Newcastle.
Every time you said a shock here, and I was thinking Newcastle, 13 games, not a single win, facing relegation, a new owner. They want to spend in a couple of months. Can they? Can they get this done? Can they stay up?
I think it's 50-50. I mean, there's been a definite improvement under the new manager, but he's only had 2 games, so I think we have to give him a bit of a chance.
Yeah, to you two guys, and we could go all day on this, but to the two of you, is this another like Man U waiting to happen where $1 gazillion is going to come in and completely change what you guys
Tom,
love?
If I pick up the phone and say, here's $1 gazillion, do you want to play for Manchester United? A lot of people might say, sure, Tom, I'll join you. If I pick up the phone and you say, here's $1 gazillion, you've got to spend 1 year potentially in the league below the Premier League next year because we might get relegated. Ian, that's a different proposition. You've got 2 massive games coming up, Norwich and Burnley. That's a relegation fight. Think about January. Ian, when they want to spend that money, you want to rebuild this business, this football club, how easy is it going to be to attract the talent in January?
Well, if we lose these next 2 games, it's going to be extremely difficult because we'll be really adrift and we'll be looking very doomed. And no big star is going to come and want to play, in Stoke on a Wednesday night in January. That's for sure.
I have no idea what that means. Are you the only one who actually cries watching Ted Lasso? Are you the only one in the room who cries watching Ted Lasso?
Yeah. Well, Newcastle United has been a source of misery in my life for the last 40 years. So, another couple of years. I mean, what difference does it make?
Yeah, it's like he's a Red Sox fan from the '60s.
Ian, it's good to see you in person too. Ian Shepperson there at Pantheon Macroeconomics. Ian brought up that line from Oxford University, Tom. No evidence that Omicron defeats vaccines. Of course, no evidence that the opposite is true either, Tom. So we need to wait for the evidence and the data.
I'm like you, John. I'm speechless over all the different things floating around. I mean, I'm really running out of words here and a lot of pontification, waiting for serious science research.
Waiting for some important data. Coming up on the Open, Jay Pawlowski of TPW. Looking forward to catching up with Jay.
Yes.
9 o'clock Eastern Time, 20 minutes away from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Financial markets appear to have been spooked by comments about the Omicron variant from executives at Moderna. CEO Stefan Bancel told the Financial Times that new vaccines will be needed and they will take months to develop. On Bloomberg TV, Chairman Noubar Afeyan said that we have to take the new variant for the serious threat it does pose. Inflation in the euro area set a record for the era of the single currency. Consumer prices rose an annual 4.9% in November. That was higher than all 40 predictions in a Bloomberg survey of economists. European Central Bank officials have been reassuring citizens that are facing a once-in-a-generation cost of living squeeze that won't last. Regulators in China have dealt another blow to Didi, the giant ride-hailing company. They've issued a formal package of rules that protect the rights of millions of drivers that underpin the industry's growth. Beijing has already ordered Didi to delist from the US. The company went ahead with an IPO in June despite official objections. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
When you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's easy for them to say, if there is any kind of restriction in the economy, we'll just ease and ease aggressively. That works when you don't have inflation. But when you do have inflation and you try to stimulate, especially an economy that's already suffering from a supply chain problem, so let's stimulate even more demand, you might wind up making it worse.
Jim Bianco Research there. We welcome all of you. Kaylee Lyons and Tom Keene getting you through this morning. Futures, -40. Kaylee, we got two pieces of research in. Burt Malik at TD Securities up in Toronto goes the other way from JP Morgan in London and looks for oil, $90 a barrel, higher, certainly higher, but then coming back down. It shows you the disparity out there.
Yeah, well, you have on the one hand a call from 125 to 150 on the other 90, which is still far above where we are now. We're trading at a 67 handle on WTI this morning, and it really goes down to those supply and demand dynamics, Tom, in a matter of OPEC Plus and its spare capacity and what it is going to be able to produce for oil-hungry consumers.
And then you get to Barry Ritholtz here trying to look out into the next decade. George Saravelos reaffirming this morning, folks, at Deutsche Bank, the COVID equilibrium, and that means lower R-star, it means lower real rates for longer, just a sluggishness out there even within our prosperity. And so much of that prosperity is around the new wage dynamic, the new labor economy. Mr. Ritholtz thinks and writes for Bloomberg Opinion. Your piece is the quiet piece every academic's focused on. Does labor finally get their fair share? Do they?
Well, it certainly looks like we're in the midst of a generational reset in terms of minimum wage. You know, we've enjoyed deflation for the past three decades. Outright deflation.
English 1930s deflation.
Right. Part of it is driven by technology, but some of it's been driven by artificially suppressed minimum wages. And what I mean by artificially suppressed, it's been lobbied by fast food companies and low-end retailers. And by any measure, the minimum wage has lagged productivity, inflation, corporate profits.
Right.
Most top half wages have gone far faster than the minimum wage. And what we're seeing now is a once-in-a-generation catch-up because this generation has left the building. They're not participating in fast food.
This generation has left the building with Amazon, Target, and others. These are massive unit job creators in these warehouses. I would suggest that part of the technology is what's moved the needle.
Tremendously. And it's amazing that Bezos did a 180 and came to the tactical realization, hey, if we crank up our wages till $15, we'll capture all these low-end workers who are looking for a job, low-wage workers, and put our competition on their heels. And they did that, and they forced everybody to play catch-up. Half the potential hires were no longer there. And on top of everything else, many of these companies couldn't compete with the $15 minimum wage floor that was set by companies like Amazon.
What does this mean for persistent inflationary pressures on the wage front, Barry?
So there are two things you have to think about, and I think some people kind of conflate the two. One is the actual level of price, and we've seen a big increase after long periods of lagging. It's caught up. The second factor is annualized rate of gains, and it doesn't appear that this level of wage increase, 6, 7, 8%, that we've seen over the past couple of quarters, it doesn't look like it's going to continue beyond this very, very far. Unless we see Amazon hiring another few million people, it looks like this is a reset, not a persistent structural, hey, we're going to have 8% wage inflation in the bottom quartile for the next decade. That's the problem with the word transitory. People sort of get wrapped up in that. Ask yourself, are these a one-time increase, or is this structural and persistent? And it doesn't appear to be structural in any way.
What are the implications then for monetary policy? Does that mean that the Fed can take it easier?
I think they're looking at the data and being patient, and I wouldn't blame them for that. I think that's the right approach for them to take. You know, we have a real problem with understanding data over a long period of time. The recency effect forces us to hyper-focus on whatever the last data point is when you have to look at this over time. Yes, of course, in 2020, inflation plummeted in the early days of the pandemic, and now it's spiked in the opposite direction. The year-over-year comparisons are artificially inflated above what is now a higher level of inflation for 2021. Once we get through this and into 2022, the base rate moderates, the year-over-year comparisons become much more reasonable.
Barry, you look at everything out there, including in your social media, your brand new Ford Bronco sitting in your driveway. A 1968 Ford Bronco is $69,000 now. I calculate off the Matt Miller antique car calculator, that's a 6% return per year for 50 whatever years. Are tangible assets like that a good investment?
Well, first, let me just warn you away from the survivorship bias you're exhibiting, because you're not telling me about the hundreds of other cars that are worthless today from that era.
Okay.
You're showing me the winner. That said, they're only making, there's only so many of these 60s and 70s era trucks.
But you have to pay for it along the way as well.
Right. You're paying insurance, you're paying maintenance, you're dealing with rust, you're repainting it, you're doing lots and lots of work. I have a couple of old cars. I haven't calculated what the value of my 60s and 70 eras wheels are, but I'm sure they're just above inflation, maintenance, and insurance. Unless it's an old Ferrari, in which case you've done really well.
Matt Miller has the old Ferrari, you and I don't. The answer is people don't take into account with tangible assets the cost along the way, frankly, with real estate as well.
Real estate, gold, if you're going to have a substantial amount of gold, you got to pay someone to secure and store that
Kaylee does
for
that.
long periods of time. So that's there's a challenge when you look at real assets. You mentioned real estate. You pay taxes, you pay maintenance. It's not as simple as it looks. And when we have, the 10-year is 1.5 and going lower, people have a tendency to look at other asset classes, and they only see the positive of it. They fail to see the cost structure, which sometimes is quite substantial. Wine, art, automobiles, and real estate, the maintenance costs are not insignificant.
You can collect wine?
Sure, there's lots of people. I would rather drink it. I think that's not my preference. And P.S., most of these wine bottles that are selling for $50,000 and $100,000, they're not drinkable. They're like
not drinkable.
They're trading sardines. They're not truly drinkable wines, but it's collectible.
I don't get it. Barry Ritholtz, thank you so much for the clinic as well. Kaylee, I look at the wrap up of the day here, and we've got this White House discussion in the 12-hour. You wonder if that turns a market either way.
Yeah, and I wonder if Jerome Powell's testimony in the Senate coming up at 10 a.m. Eastern time will turn the market either. What is he going to say about the outlook and how it may or may not change due to the Omicron variant and how much that we don't know at this point, Tom?
I'm going to go to what Kaylee Lyons mentioned earlier, folks. I've got West Texas Intermediate 67.60. Brent crude is down $13 from the painful peak of 84 a barrel, 71.02. In the 10 o'clock hour with our expertise coverage of Jerome Powell and Janet Yellen. Stay with us. This is Bloomberg.
Esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá nos reunimos con los oficiales de inteligencia de la policía. Nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Recovering just a little bit as we inch towards the opening bell. I'll get my voice back from New York City. Good morning, good morning. Equity futures down 25, negative 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. Markets facing a volatile December.
It's going to be volatile.
This new variant.
There's still an awful lot we don't know. The question I now have with Omicron is, will this affect the flows?
That volatility of volatility.
Volatility is going to be large and more substantial.
Long periods of calm spiked by occasional moments of terror.
It's basically this classic roll and carry.
And that's just the world we're living in today.
The path isn't quite so clear.
We're talking about the Fed reaction function.
The Fed is in a catch 2022 next year. The Fed does have its hands tied.
They just got a boost, if you will, of data that was very uncertain relative to the plans that they were talking about.
Any step back from the current policy path is really going to be scrutinized. It's going to be a very, very different game.
We've got a lot to work through this morning. Joining us to discuss is TPW's Jay Pawlowski, Julie Beale of Kane Anderson Rudnick, and Henry Peabody of MFS Investment Management. I want to start with how a lot of people started this morning. It was with a quote in the Financial Times from the Moderna CEO, and it read as follows: "I think it's going to be a material drop." This was on vaccine efficacy. "I just don't know how much because we still need to wait for the data. But all the scientists I've spoken to are saying this is not going to be good." We caught up with a co-founder of Moderna. Take a listen to what he had to say.
I definitely think that this threat is something that we have not seen before. The number of variations, mutations on this virus are surprising. They're not theoretically impossible, but extremely rare. And so we have to take it for the serious threat that it poses.
Julie, we heard a lot from Moderna executives in the last 24 hours. I'm struggling to understand what's new about what they had to say to the Financial Times overnight, coming into this morning to see futures down by more than 1% at one point.
I think part of the challenge is that, yesterday we had the Pfizer CEO saying, in 100 days we can have a vaccine. And this sounds a little bit more like this is a taller mountain that we have to climb. There's a lot more mutations. Maybe this is harder to impact. Does this impact children in a way that's different? I think it's just hard to keep track of where we are, and uncertainty for sure makes everyone uncomfortable.
I'm uncomfortable drawing firm conclusions on anything right now, Henry. I'm much more comfortable sounding like a broken record. We don't know enough about efficacy, we don't know about severity, and we don't really know much about transmissibility about this particular variant. Until we know any of those things, Henry, can you draw any conclusions on anything whatsoever?
Well, I'm not going to be an armchair epidemiologist, that's for darn sure. But I do think what we have to think about is positioning, liquidity, and how this impacts our clarity on markets. Remember, going into this, we were already flattening out, we were already widening in credit, forward curves were already flattening dramatically. And this, if anything, just adds a lack of clarity to the market. So what's the responsible thing to do when you think about asymmetry, and how has it changed? If anything, going into an illiquid market, asymmetry is substantially more on the downside. I'd rather give up a little bit of marginal upside than wear 50 basis points of widening going into an illiquid market. So I think what you have to do is just think about your level of confidence in markets and positioning. And this, if anything, at the margin, just reduces it. And I think that we tend to overcomplicate things, and that's the simple calculus you have to make.
Well, let's keep it simple and pick up on those two themes. Jay, positioning and liquidity. Run me through your response.
Well, it's definitely keep it simple, stupid, right? And that, thank you for calling on me, John. Yes, I think clearly we have positioning is much better. Thinking more of the equities. Henry talked about bonds, it sounds like. From the equity side, positioning is much cleaner. Sentiment is much better, right? We had a VIX up over 40%. We had a 90% down day on Friday. History tells us that when those events happen, out 1, 3, 6 months, the hit ratio for positive returns is quite high. Obviously, with Omicron, it could be different, but I focus on two things I would add. One is the speed of science. I'm very focused on how fast things are moving. And when Pfizer says they can have a vaccine in distribution, not just like in testing, in distribution within 3 months, that's down from a year with the original COVID vaccine, which itself was down from 10 years previously. The second point I would make is that we do know that the economies around the globe are strong. They're strengthening. Europe is data last week was quite strong. November PMIs better than expected. U.S. is growing in Q4 at roughly 8% on an annualized basis, according to Morgan Stanley. That's strong. China just reported overnight the best PMI data on the composite side in 6 months. Same with Japan. So I do think we have to keep in mind that the markets have learned to live over time with this uncertainty. The economies have definitely learned to live with COVID, with lockdowns. We've seen that we're now going into the third or fourth lockdown in Europe. Growth is strong. So yes, we have more uncertainty. It's going to be choppy. I think one has to be very careful if one wants to try and trade around this activity.
Jay, you picked up on an important point, how policymakers would respond to this. The tolerance level is very different in, say, China compared to Europe and compared to, say, the United States. This was the president on that yesterday. Take a listen.
I'll be putting forward a detailed strategy outlining how we're going to fight COVID this winter, not with shutdowns or lockdowns, but with more widespread vaccinations, boosters, testing, and more.
We'll hear from the president around lunchtime a little bit later on this afternoon. Julie Beale, given that understanding of how policymakers might respond to this, what we know from experience, what it could do to the economy, does that give you the confidence to buy any particular weakness?
You know, I still think that you have too much uncertainty on both sides, both the upside and the downside. So a focus on quality businesses that have some upside potential if the economy is stronger than expected, but can also protect you on the downside. A company I would think of would be something like a FICO, where if the economy is stronger, we have more access to people expanding their credit, so that will help their business. But banks are also still focusing on transforming their digital platform, and FICO helps with that as well. So those are the kinds of businesses that we're really focused on right now.
We can talk about the banks a little bit later around the opening bell. Interested to see NASDAQ 100 futures almost fully recover. We fully recovered yesterday. We took another dip lower this morning and now negative just 0.2% on the NASDAQ 100. Lori Calvasina out overnight with some research. This is what she had to say on the volatility. The nervous take we saw on Monday in which tech growth and large cap outperformed will be more representative of the kind of moves while investors wait for more clarity than the panic and fear that drove Friday's price action. In addition to that comment, she did a survey of some investors, about 95 of them, on how portfolio positioning has been impacted by this variant. Henry, this is what they had to say to this. I'm not going to do anything until I get more information was the most popular choice, 49% of the votes. Dip buyers were split between those who were buying nervously, 19%, those who were buying confidently, 22%. Henry, let's start there with you. What have you done with the portfolio in the last couple of days?
Well, on Friday, we had the opportunity to buy a little bit on weakness, and this was, sticking your finger in the air and telling your traders, back it up 15, 20 basis points, and if you can find credit, then great, if somebody's willing to hit the bid. What we did find is that there was very few who were actually hitting that bid, so it was more marking than actual real selling. At the margin here, we're using strength to reduce overall CTD or DTS risk. As I said, we're into a period of lack of clarity. And I think if we had, imagine this happened 6 or 9 months ago, when policy was not closer to being normalized, I think you would have a much more aggressive dip buying reflex. But now, the Fed is not going to change their stripes overnight. The Fed is going to stick with tapering. There's more conversation around accelerating that tapering. And in this environment, credit and risk is not going to like a higher cost of funds. When we have a 2% 2-year note, what's that going to do to everybody who took duration and credit risk? So I think we need to think about the renormalization of policy and how that's going to impact risk markets. So at the margin, it's using these bouts of volatility to position around an overall risk reduction position.
Your working assumption, though, Henry, and I want to respond to the panel on this, is still 2% on a 2-year, because the bid in the 2-year, the move that's actually sticking Friday, Monday into Tuesday, has been the decline in the front end. Yields in by 14 basis points on Friday to just south of 50, down another 1 yesterday, down 2 again this morning. Where does the 2 on 2s come from, Henry?
Oh, that's more aspirational in nature and thinking forward more than anything. Right now, the reflex in the market is definitely curve steepening and taking the Fed out. But I do think as we work through this, we need to think about, we are in the process of normalization. Growth is relatively strong. Inflation is harder to call transitory with sticky prices remaining relatively high. And we're going to see services likely stay high due to housing, medical costs, things like that. So the Fed is not going to change its stripes overnight, and we're going to have to get back to repricing towards a slight normalization of policy.
The essence of your argument, and Judy, weigh in on this, please, is something that came up on this show a couple of times 24 hours ago with Greg Peters of PGIM leading the way, that the Fed put that we've got used to, we've relied on for much of the last 10 years when things get dicey, they support the market. That is less reliable, less durable with this kind of inflationary backdrop. Would you agree with that?
Yeah, absolutely. I don't think it's going to be up to the Fed necessarily how they're able to move. If inflation really starts to take off, that's going to be problematic and they're not really going to have a choice. And I think that's a positive thing. That's an indication that we're not reliant on the Fed to support a zombie economy, right? Like choosing the US economy because of what the Fed is going to do is like choosing a spouse because their parents bail them out every time they get into trouble, right? Like, great in high school, but like that's not going to work as a long-term strategy, right? We're adults now. So I think overall that's a positive thing for the long term. Our time horizon is something over the next 5 years. And I think it's the most important thing is that we get inflation under control.
Judy, some people do that, but we can talk about that another time. Final word, Jay Pawlowski, please. Final word, Jay.
Yeah, I love all this stuff. It's great. I do think there are opportunities in the market. I would point out Jets as a reopening trade. Year over year, or 2-year airfare spending was up for the first time since COVID. In the stock, the Jets ETF has been crushed. European banks, likewise, massively oversold. And then finally, John, I'm getting very keen on Asia. You know, I've been very bullish on Europe for the last 18 months. That bullishness is now shifting to Asia. I think both Japan and China are very interesting. And I would just point out that last night, with all this uncertainty, China barely moved, was down less than 0.5%. So I do think there are opportunities.
The PMIs, as you mentioned as well, decent overnight, better out of China too. Jay, Julie, Henry sticking with us. Coming up, investors gearing up for Chairman Powell's testimony amid mounting virus and inflation concerns.
It's clear that central bankers want to remove accommodation. What they're most focused on actually is not the virus itself, but inflation. I think there's intense political pressure around the inflation front.
That conversation up next from New York. This is Bloomberg.
Front, when your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I do think the emergence of this new variant makes stagflation a little bit more of a risk. The Fed's in a little bit more of a jam even than they were in before. So I do think this reduces the likelihood of increasing the velocity of the taper, which I think would have been a possibility, you know, I probably would have expected that if you'd asked me a week ago.
The Fed Chair Jay Powell preparing to testify on Capitol Hill alongside Treasury Secretary Janet Yellen. The Fed chief addressing the Omicron variant, saying the following: the recent rise in COVID cases and the emergence of the Omicron variant pose downside risk to employment and economic activity and increased uncertainty for inflation. Bloomberg's Michael McKee joins us now. Mike, I'm wondering what he means by that last bit. Inflation uncertainty.
Well, I think what you have to do is go back and re-look at that statement from the Fed chairman and pick out the important words. And that's what we did. Look at this quote right here. The words poses risk, increased uncertainty, could reduce, would slow. A lot of qualifiers in there. Jay Powell's going up to Capitol Hill today, and everybody's going to want to know what the Fed's going to do about tapering and interest rates, and he's going to want to push back on that, saying we just don't know at this point because we don't know enough about this new variant. Mr. Market has to price every minute of every day, but the Fed does not. They don't meet until December 15th, and here's what they see on a regular basis. You can probably expect Powell to talk about it today. The economy has performed better through each successive COVID wave. Consumer spending continuing to rise, and lockdowns and restrictions as measured by the stringency index have eased. Even if Omicron is bad, it's not a guarantee that the economy will turn south. At the same time, the Fed chair does not want to signal that that means a faster pace of rate increases. In his statement, noting there's still progress to be made on unemployment and on labor force participation, joblessness continues to fall disproportionately on blacks and Hispanics. So even if they taper, they're going to want to leave rates alone as long as they can. They're going to have to wait for the data, which is what he'll say. He may struggle to make the case on inflation, but expecting to stick to the Fed's view, it will fade next year unless, of course, Omicron changes the facts.
How relevant do you think the data is this Friday, Mike?
It's going to be very relevant in the sense of if you leave Omicron out of it, or Omicron, or however you say it. That's the big debate out there, I guess. Because the Fed, at this point, doesn't know what it is going to do to the economy. And this is backward-looking data, but it will show us how far we've come. So the Fed's going to be looking at job creation on those unemployment rates, particularly for minorities, and we'll be looking at the participation rate.
Mike McKee, the data, a few days away. Mike, thank you, sir, as always. How important is the economic data this week? The ISM on Wednesday, tomorrow, and then payrolls on Friday. This is what PGIM's Greg Peters had to say.
I don't think the data really matters much this week, to be brutally honest. It's more around the rhetoric coming from Yellen and other Fed officials to see what their reaction function is to the virus. The data takes a back seat this week. It's more around the rhetoric and then more around more clarity of the virus.
Back with us, Jay Pawlowski, Julie Beal, Henry Peabody. Julie, do you agree with that? The data takes a back seat this week.
I think so. I think we're going to continue to be in a pretty emotional place where we're responding to one CEO's comments on vaccine efficacy and such. I don't think we're going to be in a place where we're really looking at the data because it's much less relevant with this variant in place, particularly as it relates to how it impacts. So if the turbulence of it and if the impact of it is less, that's great. But if it's more widespread, more transmissible, and it impacts children, which there are early reports that it does, that has a massive impact on the U.S. economy. I'm the proud owner of a 3-year-old son, and that is something that gives me pause. And I'm not even that great a mom. So I think regular moms everywhere are very concerned that this actually could finally be a variant that impacts children.
Yeah, and that's a worrying state of affairs for a lot of people around the world. Henry, if you're the chairman right now going into December 15th, and I offered you one thing, I'll give you the efficacy data for this variant, or you can have the payrolls report on Friday. You're taking the former, not the latter, aren't you?
100%. 100%. And, I don't envy his job in the least. You have a pandemic, you have supply bottlenecks, you have hard to explain behavior of labor markets, and you're expected to unwind one of the largest monetary policy experiments in history. So his job is hard, but we do have to remember that we have an improving fiscal thrust. Growth is relatively strong. Unemployment is low, depending on how you look at it. So at the margin, I think what he's doing with some of this commentary, which is wise, is building in a whole heck of a lot of flexibility. And that is a wise move going into this level of uncertainty.
Do you need to wind down the tapering much more quickly to retain that flexibility, to have that optionality? Bloomberg Economics out this morning, Jay, saying they expect the taper to double the pace starting in January and wind down completely. The process finishes in March to get that option to maybe move on rates more quickly. Do they need to move more quickly on tapering, Jay, to have the flexibility that Henry just described?
Well, John, one of the things we haven't touched on seems to be leaching out of the conversation is the potential for Omicron to be better than expected and to be more transmissible and mild. If, in fact, it's more transmissible and mild and therefore spreads more quickly, we should welcome that. And in which case, yes, the Fed will need to taper faster. I think, as one of the folks you put up on the screen before said, on the last 4 days, most people would have expected a faster tapering. Now the Fed will have several weeks. We will have much more information. Again, that speed of science. much more information in the next 2 weeks to make that decision. And it could well work out that that's the case, that this is found to be, yes, more transmissible, but B, mild, in which case, you know what, the Fed probably will go ahead and accelerate that tapering process. My view is that higher rates are bullish for equities. Bonds, I don't think are attractive at all. Commodities, I think, are very interesting here. I continue to look for a year of some relative normality in 2022, some additional clarity. Supply chain worries are already ebbing. Energy shortages already ebbing. We start to focus on the traditional things that market participants look at, shift from liquidity to earnings, from growth to value, from bull market and bonds to bear market and bonds. That's the upside, I think, that we can look at. And look, whatever we give back now in terms of 2021 performance, we can get potentially in 2022. And therefore, thinking beyond the next 1 month, the next 3 months, the next 6 to 12 months, the opportunity set looks to be getting better, not worse.
I don't think the bear market in bonds is the opportunity or upside risk that Henry Peabody's thinking about right now, Jay. We can discuss that in a moment. Jay, Henry, and Julie sticking with us. Just on the taper, this from TD, agreeing with the likes of Jay that maybe this removes some of the urgency for the Fed to do something more quickly. The uncertainty removes the urgency for the Fed to announce a speed up in its taper and by extension, an earlier Fed liftoff. We've been pulling forward rate hike calls and now over the last couple of days pushing them back out. Up next, your morning calls, and later the financials pointing to another rough open after Chairman Powell's Omicron warnings weigh on the big banks. From New York, this is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, but we still are seeing, like your reporters are seeing, some stock outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
Minutes away from the opening bell in New York City. Equities recovering just a little bit. Futures down by 0.5% on the S&P. We're down 25. Let's get you some morning calls. First up, Bank of America upgrading Square to neutral, taking a more constructive stance after the stock's recent 25% decline. Goldman downgrading Dollar Tree to neutral. The analyst highlighted the stock's pricey valuation and declining in-store traffic. And finally, HSBC initiating coverage on Beyond Meat with a reduced rating, seeing a number of headwinds, including lofty growth expectations and increasing competition. That stock is negative 2%. Coming up, the big banks extending their slump, pointing to a fourth day of declines following comments from Fed Chair Jay Powell. The opening bell is up next from New York City. This is Bloomberg.
When you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bout. It's Tuesday morning. Good morning to you all. Here's the price action. Your equity market is down 26 on the S&P, rebounding, recovering just a little bit from session lows. We're down 0.6%. On the Nasdaq, we're down 0.2, recovering. We're down 33 on the Nasdaq 100 futures. There's your opening bout. Switch on the board and get to the bond market. Yields down on Friday, higher on Monday, lower on Tuesday, down 5 or 6 basis points on 10s to 144.26. Euro dollar, we need to talk about that inflation print in Europe. Hot, hot, hot. It's not just America, it's the rest of the world. The Eurozone with an inflation print just short of 4.9%. Euro dollar 113.67. Positive there, 0.7%. Crude, 67.37. I said earlier on this morning, we're down in the way the administration might like it to be lower, but not because of the reasons the administration might like it to be lower. We're negative almost 4% now to 67.37. Around the opening bout, equities are lower by 0.6% on the S&P 500. Every single industry group on my screen is negative. We are led lower by energy, off by 1%, financials off by a similar amount. We caught up with JP Morgan's Jack Caffrey, expecting traders to continue buying the dip. Take a listen.
I don't think we question buy the dip yet, because I think this is a Fed that's going to remain on the reactive side rather than responsive. They just got a boost, if you will, of data that was very uncertain relative to the plans that they were talking about. They're going to find now reason to be a little bit slower to move, but I think that the challenge from that could be slower now means faster later.
Based on earlier comments from Henry and Julie, they disagree with Jack. Jay Pawlowski, I sense you agree with him.
Yeah, I do, John. I think, look, we have a negative rate environment, negative real rate environment. We have solid global growth. We have decent earnings, as I talked about earlier, sentiment and positioning, et cetera. I think the history of COVID over the last 2 years is twofold. One, the economies figure out how to work, and I think the bond market is missing that. And two, buying the dip is the right thing to do. And I think, given what I just suggested, that continues to make sense. I think the question is really, where do you buy the dip? Because the market, as always, is giving some specific opportunities, while others may look like opportunities, but are really not. And as a global multi-asset guy, I talked about a golden age of asset allocation a year ago, and I think we continue to be in that golden age of asset allocation. There are multiple opportunities across assets and around the world.
Well, Jay, let's talk about that now. Dan Ives, a well-known tech bull on Wall Street, had this to say: while volatility and news flow around the situation will grab the headlines, our playbook remains unchanged. We view this risk-off event as a clear buying opportunity to own the tech winners for 22. Now, Jay, tech isn't something that often comes up with you. Usually there's this cyclical theme, this cyclical tilt, Europe, Japan, and Asia feel to it. Where do the US tech players fit into all of that?
Yeah, they really don't, John. In our model portfolios, the focus has really been on thematic versus FANG. So our bet is that the thematics around climate, around cyber, around crypto, or really want to have the opportunity set for things that are tech-like or trade-like technology. So that's really been our bet, and that bet has worked. The thematics have massively outperformed the FANGs this year. And by the way, so has energy massively outperformed the FANGs this year. I think that will continue to be the case. So look, my view, as I said, is the bond market is misreading the fact that the economies are able to operate through COVID. That is what has been proven over the last 2 years. It's only going to continue to be the case, in my view, going forward. I think the 10-year U.S. Treasury bond will trade at 2% by June of next year. I think technology stocks will underperform, cyclicals will outperform. And as I noted, I think the real opportunity set is in Asia, both with Japan, which is recovering, has been the big laggard because of its lockdowns, recovering now into an Asian reopening, and then China. I think China is probably going to be one of the best performing markets, both debt and equity, in 2022. I expect a glide path year. They have a full policy quiver. Market has been bombed out. They have the potential to add monetary policy to support a weak economy. Yeah. I like both high yield, government debt, and equities. I'm pretty overweight China across the board. I think that's the real opportunity.
It's been a tough year in China, that's for sure. There were 2 trades in there, not just China. That was the geographic regional trade. Within that was a call for 2s on 10, 2% on 10. Now, Henry, I want to come to you on that because you talked about 2 on 2s. Let's talk about 2 on 10s. 2 on 10s right now, 144. Yields coming in 6 basis points. Do they belong at 2%, Henry?
Probably. I think if you look out a year or so, I don't think that's a Herculean call. I think we probably do start to move in that direction. And one of the things I do wonder a little bit about, we've had this increase in inflation prints, a lot of it on year-over-year comps, a lot of it on bottlenecks. We've discussed this ad nauseum. That's pushed real rates lower, that's boosted equities. Now, what happens when those year-over-year comps start to roll over, which mathematically they will to some extent? Does that push real rates up a smidge? Does that provide an impetus for equity vol to pick up? I'd sort of ask that open question as perhaps a catalyst to risk assets on the credit side beginning to widen perhaps materially. From a sector perspective, because you were talking about it earlier, and banks were brought up, that's been one of the main areas of focus for us. Banks represent, we think, pretty good value versus industrials. On a ratings for ratings basis, you're picking up yield, you're picking up liquidity, you're picking up quality. And for us, I think that certainly last year with the increase in reserves and the requirement to issue TLAC capital, that supply wave was pretty intense. And we think that's going to unwind next year. So that for us is a good place to be overweight.
I'm keen to get Julie's response on the banks. I want to turn to the banks right now. The financials are lower this morning, off by a little more than 1%. On the S&P, we're lower by 0.6%, down for a 4th straight session now. The likes of JP Morgan off by 1%, Morgan Stanley, Bank of America down by in and around 1.5%. On the banks, here's Kelly Lyons.
Hey, John, well, these losses for these banks over the last week now add up to about 5 to 6% each, even more so in the case of Wells Fargo, which is down more than 6% over the last 5 days. And this is really just a rate-sensitive story. Of course, the banks benefit when yields are higher and the curve is steeper. And instead, what we've gotten recently is a flatter curve and lower Treasury yields as the market weighs the growth implications of the Omicron variant, of course, pushing back expectations for the tightening of Fed policy. So as a result, the 10-year yield back down to south of 144 this morning, the lowest in more than 2 months. And it's taken the banks down with it. What we're looking at here is that Treasury yield in blue, and in white, it's the ratio of the S&P 500 banks index to the technology index. And you can see the banks losing their relative strength over the last several months. And at the same time, technology has found a firmer footing. That's been the story really over the last 6 months or so since the Delta variant first came to the fore. The NYSE FANG Plus index, a great gauge for big tech in particular, is up about 17% over that time. At the same time, the broader S&P 500 is only up about 10%. So the outperformance there for big tech as people maybe look for a little bit of defense, a little insulation, and of course lower treasury yields do a favor for those richly valued stocks, John.
Kelly, thank you. That industry group suffering a bit this morning. The S&P 500 more broadly now down 0.75%. Some outperformance on the Nasdaq. We're negative there, just 0.4%. On the banks, here's Wells Fargo's Mike Mayo betting on some of these names and writing the following. We still expect banks to grow book value, increase core earnings. The new variant shouldn't derail efforts by the industry to embrace and facilitate the recovery unless vaccinations fail to effectively protect from the new variant. Remains to be seen whether that's true or not. Julie Bill, can we get your take, your view on that industry group right now, on the financials, on the banks?
I think that the long-term outlook for financials is pretty positive. I think it's hard for us as investors in trying to find really differentiated businesses to focus on banks because there's not a ton of differentiation there. So I would actually prefer to play a technology that serves the bank. So something like a Jack Henry, where I think they have lots of positive indicators in front of them and the ability to continue to digitize and modernize a lot of financial institutions. So I would rather do that than a bank, but I can see the argument for why bank stocks could be appealing, especially as they've traded down.
Where do payments fit into that, Judy, more broadly? The likes of, say, PayPal, Square, of course, back in the news because of Jack Dorsey in the last 24 hours. Where do they fit into that theme?
I think payments is a really interesting space. The problem with payments is that it's become an extremely competitive place and it's a scale business. So, you know, as a small and mid-cap investor, I don't see a ton of opportunities for me investing in the payment space, but in the large cap side, I think it makes a lot of sense because these are really genuinely scale businesses. They're very disruptive and there's a lot of opportunity in front of them.
Jay, I want to come to you on that, on the bank specifically. As you look across to the rest of the world, if you're going to be overweight in places like Europe, naturally, just given the character of the index, it takes you towards the banks. So you're comfortable there, Jay?
Yeah, more than that, John. We own the banks, European banks specifically through EUFN, which has been massively oversold. The RSI on a 14-day basis is down around 20, so significantly oversold. And on Friday, had the biggest down volume day since COVID began. So to me, that's a real opportunity. I also note that Morgan Stanley and others have upgraded the Japanese banks recently, and the Chinese banks have also seen recent buy tickets by the big research firms. So to me, I think I own XLF. You know, we do mostly ETFs, so we own XLF on part of our cyclical play here in the U.S., but I think the bank opportunities are probably better outside the United States. And in particular, in this sell-off right now, I think the European banks offer some significant opportunity with yields around 3 to 4%. For anyone who has a view or a time frame that's longer than a month or two, I think the European banks are very compelling here.
This year, they've performed. They're up more than 25%. Looking ahead to next year, Jay, you've mentioned China a couple of times. I've talked about comfort levels there. How uncomfortable is that, Jay? You're open and honest with me at the best of times. Talk to me about it now. Given what's happened this year, and given that you can wake up at any moment and China can decide, the Communist Party can decide what your returns are going to look like, maybe, for the downside next year.
Oh, I don't think that's the case, John. Look, I think there's uncertainty everywhere, as we've just been talking about this morning. And to me, China is, as I said, I think China will be on a glide path in 2022. That is the year, a year from now, when President Xi is likely to get his third term. It's virtually assured, given the recent party meetings that have been held. So glide path year politically. That's why they went and did all the unpleasant things in the summer. Yeah. Investors have had every opportunity to sell based on those edicts in August, based on Evergrande. Remember Evergrande? It was going to ruin the global economy, okay? It was an opportunity to sell. And your point and my point is that anyone who's wanted to sell Chinese equities has had every opportunity to do so. And thus, there are no more sellers left. And you can see that when you look at the market activity levels. Then you switch to the currency. Very stable, very strong currency up against the U.S. dollar. So you can buy local currency debt, high yield debt, yielding 10% in dollars. You can buy Chinese government debt yielding 3%. Their 10-year is at a 3% yield. Ours is at 1.4. You can buy the local government debt. You can buy the dollar-denominated high-yield debt. You can buy the equities. China sells at a 20-year relative low on a valuation basis to the United States equities. So here in this environment, I like to look at the laggards, right? I think buying technology in the United States right here will prove to be, over the next 6 to 12 months, a massive mistake. I think the opportunity is to go and look at things that have already been beaten up and buy those, and that's China.
Never mind Evergrande. Do you remember Evergreen? Do you remember that earlier this year? I mean, that one truly was transitory. That one faded to the background. Guys, before you go, Henry, I wanted to come to you on this because I think it's important. We started to see credit spreads widen out more materially over the last week or so. I want a view from you just in terms of coming in and out of the market, how easy that is, what you're seeing in terms of primary issuance. Is there anything that reminds you of late 2018? Anything at all, Henry, in your mind when you look at credit in America at the moment?
Yeah, and I think it's important to remember that I was having a conversation with another portfolio manager at MFS yesterday, and he wisely said that the exit door gets really small. And when you look at the behavior of the primary markets, you look at something like an increase in BDC issuance, which says to me it's fairly late cycle. The question is was COVID a cycle or not? And I think that lack of liquidity combined with some frothy issuance, which completely evaporates when you have a backup in spreads. But I think that is signaling to us that asymmetry is to the downside. And at MFS, we really like to think long term. And for us, taking that risk right now is not the right risk to take. When liquidity risk, for example, is dear and there's value there, that's when we'll come back to the market and use our collective wisdom to do so.
I just had to balance out some of Jay's equity bullishness with some of Henry's more credit cautiousness. Jay, it's good to see you. Henry as well. Likewise. And the wonderful Julie Bill. Julie, thank you, as always. Coming up on this program, inching closer and closer to that December deadline in D.C.
They're going to have to vote on really contentious issues. The SALT deduction, nobody really wants to talk about that on the progressive side, but moderates do.
The latest from Washington, up next.
Young woman that's watching this wants to be the next Diane von Furstenberg, what would you recommend?
Be as true to yourself as you possibly can. The more you could be you, the happier you will be.
There's a pretty good chance that you use products made by Meta every single day. If you've never heard of Meta, that's because it's the new name for Facebook Inc., the parent company of Facebook, Instagram, and WhatsApp. Perfect. In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Senior White House officials have been in close touch already over the last several days on moving our Build Back Better agenda forward. I was meeting with Leader Schumer's team last night, so I can assure you we are moving forward full speed to get this done, and we expect action on it in the coming weeks.
The Biden agenda facing yet another hurdle, SALT negotiations faltering. Senator Menendez blaming the snag on Senator Sanders, saying the following. We said we believe the SALT should be whatever, it's revenue neutral. And that's what I thought we were doing. Now it seems that Sanders has desires of using some of that revenue by cutting back. For more, from D.C., our correspondent, Joe Matthew. Joe, what's the latest, sir?
Salt in, salt out. It depends on whether you're talking about the Senate in this case or the House, Jonathan. This has just been a story that won't go away. As we've been discussing, it's really symbolic of how little progress has been made on reconciliation on President Biden's social spending agenda, specifically in the Senate. We knew it would come back to the House eventually, assuming that it will, in very different form. This is a real sign that they've got a long way to go, even as Chuck Schumer hopes for, and in some cases promises a vote by Christmas. But Jonathan, we're talking about a lot of stuff in Washington today while everybody's focused on the variant. Before we ever get data on that strain, there are actually a couple of really important deadlines that are looming, aside from reconciliation, social spending, infrastructure, and so on. Number one, Friday, that's when government funding expires. We do expect a short-term solution, another kick-the-can solution. The question is how far, maybe mid to late January. And then, Jonathan, we've got to deal with this debt ceiling matter. Originally, we were set to or expected to hit it on Friday. It looks like it'll be somewhere between the middle of December, January. But as you know, this is not about sticking the landing. They need to figure this out before we get to the cliff.
Joe, thank you. As always, looking forward to Sound On Bloomberg Radio, 5 p.m. Eastern Time. We will hear from the president a little bit later on today on COVID and their response to it. On that, in this equity market, here's Abby.
Well, John, you know, with this Omicron threat and the fears around it, we are seeing the travel trade decline right here. If we take a look at the airline and cruise operators, we're going to see solid declines, down more than 1% and 2% in some cases. Not plunging, but nonetheless risk off. Hilton hotels down as well, down 1.1%. Airbnb down just fractionally. But you can see the story here that the reopening trade not doing so well in the threat of Omicron. So if we take a look at the bigger story, though, oil down 3 days in a row at Friday's lows, down 14%, below the 200-day moving average. Long-term buyers simply not stepping up to support. Very similar reaction to early 2020, suggesting that some traders are fearful. It'll be interesting to see how OPEC reacts to this, along with, of course, the reserve release from last week. And then finally, you would expect that stay-at-home would be doing well. That's not really the case. We have modest increases today, but on the year, the stay-at-home trade just basically stuck in a range. So much uncertainty, investors and traders trying to figure out how to play this new variant, John. And right now, stay-at-home not benefiting in the way that some might expect.
It's going to take a while, Abby. Not what investors want to hear, of course, but we need to wait for that data. The equity market is lower by 0.75% with the sector price action. Here's Kriti Gupta.
Well, good morning, John. You just heard Abby talk about the normal winners not actually performing today, and it's a similar story when you talk about healthcare in particular. In fact, the movers that were leading the S&P 500 higher, they're actually leading the market lower. I'm, of course, talking about Moderna. On a sector basis, though, you see that defensive outperformance a little bit. Tech at the top of the leaderboard, those yield-sensitive stocks, financials, for example, at the bottom. A lot of this, though, the broad decline, whether it's on a sector basis or on an index level, has to do with the efficacy of the vaccine, Moderna in particular, especially as well, as some of those drug makers, those COVID antibody cocktails from Regeneron, from Adagio, from Eli Lilly, all declining today because, John, we just don't know how we can deal with this virus and what's coming next.
I'll keep repeating it. It's going to take a while. Kriti, thank you, as always. That's the equity market. Bring up a bonds board quickly, 2s, 10s, and 30s. This equity market's been all over the place. One way Friday, another move Monday, another move Tuesday. Another way in the bond market on 10s. Friday, yields lower, aggressively lower. On Monday, yields higher, then lower again. But one thing has remained the same from Friday, Monday, Tuesday. It's this bid in the front end of the yield curve on 2s. On Friday, down 14 basis points. On Monday, down 1. On Tuesday, down another 3 basis points. The game has changed a lot in the last 3 days when it comes to Fed rate pricing, and it hasn't been whipsawed Friday, Monday, Tuesday. It's remained the same. It's just kind of stuck there, and I find that interesting that the front end of the yield curve has been so anchored. We'll hear from the chairman at about 8 minutes' time, his testimony through the day. Then on to December 15th. There is a view out there that maybe we've had to push back those rate hikes or that debate around those rate hikes after pulling them forward. 2s at 46 basis points. One to watch in the bond market. Coming up, the market moving events you need to be watching. I'll get you your trading diary. Your trading diary into the weekend in just a moment. From New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Lini Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the quarter 3 was the quarter that was most affected.
I just wonder how important the payrolls report will be this coming Friday. If I could guarantee you one thing right now, efficacy data on the vaccine against this new variant, or the payrolls report on Friday to make some investment decisions, I think you're going with the former and not the latter. So I wonder how much we de-emphasize the payrolls report into Friday. Going into that, equities are lower. About 26 minutes into this session, we're down 0.6%. We've been whipsawed Friday, Monday, Tuesday. This morning, at least for now, we're lower. That's the price action. Let's get you the trading diary, what you need to be looking for. Fed Chair Jay Powell, Secretary Yellen testifying before the Senate, top of the hour. Plus, more Fed speak through the day. Williams and Clarida leading the Fed speak today. President Biden delivering remarks at 10:45 Eastern. We'll get comments from him about infrastructure later in the afternoon. Chair Powell, Secretary Yellen, day 2 in front of the House tomorrow. Plus, we'll get ISM manufacturing numbers. Another round of claims coming on Thursday. And finally, we wrap up the week with the payrolls report this Friday. 550K, your median estimate. 800 at the high end, 375 at the low end. From New York, this was the countdown to the open. This is Bloomberg.
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest-hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you'll use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer